We'll have a little music before we jump into
Pretty groovy.
tariff talk.
Pretty groovy.
I got you, Jordan. John Blake in the chat, loyal listener there.
Little dub going on. It'll be the late night podcast will have the EDM.
What is going on, investors? Hopefully, you guys are doing well out there. It is Liberation Day across America. Some people saying in the chat already they're liberating us from our money, and that potentially is what is happening. After Trump made his announcement, this came after the bell today. We are seeing futures in the after hours. This is the Russell 2000 futures down over 4%. Now, it has bounced back a little bit. This thing was down over 5%. Those have bounced back. Who knows where these things go on the live stream? NASDAQ futures down about 3.8%. Those were down over 5%. The market is digesting the news that came out after the bell. S&P fluctuating, but down about 3%. Futures in the after hours. Across the board, you have massive, what they are calling reciprocal tariffs on basically every country across the globe, including China, which, as it's printed here, has a 34% reciprocal tariff, but that goes on top of the previous 20% tariff that was put in place over the past couple of weeks. So you have a 54, that's right, a 54% tariff coming on all goods coming from China. I think there probably are some exceptions, but a 54% tariff from the great country of China is probably going to impact prices. We're going to be talking about a lot of things on today's live stream. Obviously, the price action, how it relates to your investments, both short-term and long-term. We'll talk about what the Trump administration is doing. As Trump gave his talk today, I think we can all agree, whether you're a Trump supporter or you're a Trump detractor, he may not be the best messenger for these types of things. He has his own style, obviously, that in some ways obviously got him elected, not just once, but twice. But also his style is obviously controversial. About half the country doesn't like him. And so the way he's communicating these types of things may not actually be the best way of communicating. So we'll talk about some interviews that I've pulled some clips of some members in his cabinet that actually explain exactly what the Trump administration is trying to do with these tariffs. And a lot of it actually has to do with the United States debt. And so as we have a discussion tonight, obviously it impacts our wallets. It impacts the prices that we're paying at maybe stores like Walmart or Costco or certainly Amazon. But this also could impact the national debt, which has at the current time is standing at about $36 trillion. If we did not have a national debt, what Trump did today was absolutely extraordinary and probably slightly reckless. But in the context of a large national debt, well, potentially what he's doing today could help solve that. At least that is the plan by the Trump administration. I am joined today in the background. We have a super producer. My brother Ryan is in the background. We appreciate him joining us tonight. But live here for the very first time, professional trader, former hedge fund manager, Mr. John McHugh. How we doing tonight, my man?
Doing excellent, Colin. Excited to be here with you. Excited to share a little banter, a little insight into a pretty exciting day, not just, I guess, entertainment-wise, but regarding the financial future of the country and for most of our listeners. So this is going to be an exciting conversation to have.
Yeah, so I mean, let's just jump right into it. We'll get into the kind of the details and the nuts and bolts of what is happening. But let's just say you're sitting out there. I know you trade. You also are more of a small cap guy. So I'm looking at the Russell. Things down year to date 13%. Over the past year, you were down 6%. Overnight, you're down nearly 4.5%. As a trader, are you sidestepping this market? I know I'm sitting back. I was doing some trades and stuff, and I like totally step back from that because it's like I don't actually like to trade when Trump can come out after the markets, put on a speech and, say some stuff, and then all of a sudden futures are down 4%. Is this something that you sidestep and you wait until you get clarity, or are you in here trading this market on, I guess it would be Thursday morning? What's the plan, at least from a short-term perspective, that you have?
That's a great question because the question what to do from a short-term perspective is actually quite different from what you do if you're a long-term investor. But if you are a trader and you're looking for trading opportunities, well, this is a pretty good clue that the next 4 years there's going to be a lot of volatility to trade. So if you're a trader, you're just looking for volatility. You're looking for big swings, and you're looking for a lot of unprofessional or novice traders that are acting emotionally. So you would be looking for extremes in emotion, which we'll likely have tomorrow. There's been a lot of emotion in just the comments about the president's presentation today. So you can look for extremes in emotion, and then you can look for technical clues in the charts, which Colin, both you and I have been using to look for ideal entry points for either long-term investments or trades for the better part of 2 decades. So I would use a combination of those two. Look for the extremes in emotion, and when people are when there's extreme fear, that's when you want to enter a trade to go long. Or if there's extreme greed, that's when you either start selling or you like to go short. And then there's always clues in the technical patterns that have been very reliable this year. So there've been a lot of short-term trading opportunities, even though, as you mentioned, the small cap stock index is down about 13% for the year.
Yeah, shout out to the chat. We've got a lot of people joining us today, including many people that I recognize in the comments. We've got Drizzy Did. Always appreciate his questions and his comments. Mr. John Blake, longtime viewer of the channel. A lot of you joining us tonight, so we appreciate that. Go ahead and drop your questions in the chat, and we will answer those as we move through the evening. So I tell you what, John, you've kind of described as a short-term guy. You probably got your charts up. You're probably drawing your technical lines, whatever indicators you want to go. But I tell you what, these things are moving, and they're moving very quickly. I mean, we have been red really since the end of December. And things have not turned around at all. Certainly, Mr. Trump is not making stocks great again. And his Liberation Day, where he slapped these what he's calling reciprocal tariffs. I don't think that, first of all, I don't think that's the best word for all of this. I don't necessarily think most people will understand this. Also, tariffs from an economics perspective. Look, we've probably all heard the commentary about tariffs over the past several weeks, whether you're watching CNBC, you're listening to a podcast, you get on, 9 out of 10 economists are going to tell you tariffs are not great for prices, probably going to drive prices up, not probably, but more than likely going to drive prices up. Those prices tend to get passed down to the consumer. In some cases, the supplier might eat some of the tariff. So, for example, if you got a 20% tariff, it's potential that, the supplier eats 10%, takes that off of their profit, and then they pass the rest down to the consumer. This is all in an effort to drive manufacturing back to the United States and create more manufacturing jobs here in the United States, benefit farmers, benefit the Rust Belt, benefit a lot of the states that actually helped President Trump get elected for the second time. Now, one thing that I think is going slightly unnoticed by the media is how bold of a move this is by President Trump, and that most politicians out there actually would not do what he is doing because politically it has a ton of risk. Obviously, we're seeing the reaction in the stock market after hours. This is not something that makes even many of his supporters very excited about what is happening. But there is some underlying stuff going on here, and we'll start a little bit of that conversation as it relates to what Trump is trying to do here. We've got this big national debt here, and so you have to do, and John, I think you can probably agree with this, to cut the debt or to get the debt more under control, you have to do probably two things here in the United States. You need to cut expenses and you need to raise revenues. And depending on what side of the aisle, whether it's a Democrat or Republican, you could have different ideas on how you raise revenues. You might tax the rich, you might tax corporations. That's certainly one strategy. The other strategy is doing what Trump is doing. He is trying to do basically kind of a use tax, almost like a tariff is almost like a sales tax. And he is trying to use that to pay down the debt. Now, you may not believe me, but this has been actually the plan all along. I'm going to play you a clip from the All In podcast. This is Howard Lutnick. And if you're not familiar with Howard Lutnick, I believe he's the CEO, or he might be the former CEO at this point, of Cantor Fitzgerald. He's actually what I would describe as a 90s Democrat. And he has donated in the past to the Hillary Clinton's campaign, to Chuck Schumer, but he is now best friends with he's been best friends with Donald Trump for a very long time. And ironically enough, Donald Trump used to be a Democrat as well. And his plan is to balance the budget. And I don't think really Trump really ran on balancing the budget. It is certainly something that they talked about, but they are running on balancing the budget. I want to play this clip and we'll discuss it after it airs.
And I said, I want to balance the budget of the United States of America. And this is the way we're going to do it. No one's ever checked the just under $4 trillion of entitlements. Every politician thinks what you have to do is you have to take the retirement age from 65 and make it a 70.
Right.
And you have to do this and this and this and this because they never think about the money.
Totally.
But people like us would say, what's the first thing you do? Well, what's the value I'm getting for my money?
Totally.
Right? And what you find is if nobody ever, like as in ever, like I could say the word ever 12 times, has looked at where the money goes.
Totally.
And so there's not even a process to get it back when you send it to the wrong person.
Totally.
You just send another one out.
Yeah.
Like think about it. I sent it accidentally or accidentally. Notice how it's accidental.
Right.
It's always accidentally sent to the wrong person. Really, you wouldn't ever say the 5.9 million people who work for the government. There could be some crooks in there.
Right.
No. It's all accidental. What a load of nonsense this is.
There's some percentage of this.
Well, but you would say,
yeah.
And you would say,
no, just zero base it and let's figure out where
it's got to be 25%.
Yeah.
We'd all say if it's never been checked, how could it not be 25%?
Right.
How could it not be?
Right.
And the answer is that's $1 trillion a year.
Right.
Okay. So I said, I think we're going to cut $1 trillion a year in expense. And then I think we can, through tariffs and other means, we're going to get revenues of $1 trillion. Okay?
Incremental revenue.
Incremental revenue.
Yeah.
And we're going to balance the budget.
So there you go. There's Howard Lutnick, and I think you can probably tell why he and Trump are best buds. I mean, those guys are literally cut out of the same cloth. But to summarize a little bit of what he said there is essentially the United States is running on a $2 trillion deficit. So they're basically spending $2 trillion more per year than what they take in terms of tax revenue. So the plan is, and in the plan all along, has been to cut $1 trillion, and that is primarily through Doge. And ironically enough, I don't have the clip up here, but Howard Lutnick, it wasn't Elon Musk that came up with the Department of Government Efficiency. It was actually Howard Lutnick who came up with that term, and he registered it as a trademark and all these types of things. This is what you are seeing from Trump when he is giving this speech and he's talking and he's saying all these types of things. He's obviously, first of all, he's reading from a teleprompter. But he's really reading off a teleprompter that Howard Lutnick is controlling right now. Howard Lutnick is the one that is coming up with all of these plans. They announced after the bell they have an external revenue service, not just the internal revenue service or the IRS, which we've all got to pay, I guess, in about 2 weeks' time. But now you have an external revenue service, which is in charge of, I assume, trying to collect some of these tariffs and make sure they're getting paid. That was also Howard Lutnick's idea. And so his idea to balance the budget, which needs to be balanced off by about $2 trillion, is number one, cut about $1 trillion in expenses, which is Department of Government Efficiency or Elon Musk's job. And then Howard's job is to come up with $1 trillion in new revenue. And their way to come up with $1 trillion in new revenue are these reciprocal tariffs. So you can say what you want about these tariffs. You can see the impact they have on markets. We are seeing the S&P 500 continue to bounce back, now down about 3%, NASDAQ nearly 3.5%. These things continue to claw back. The Russell down about 4.3% in the after hours. But John, let me ask you this question. Under the context, and I don't think Trump, I listened to this hour-long thing today. Trump did a terrible job outlining what these tariffs are for. They are to balance the budget. And I think it would be an easier sell on the American public if they would just come out and say that. Trump obviously pandering to United Auto Workers and a lot of farmers and people in his base. I don't necessarily discredit any politician from doing that. But what do you think about what Howard said there and the plan to use these tariffs to raise $1 trillion in additional revenue, combined with $1 trillion in spending cuts to balance the United States budget? What do you think about this plan, obviously, just from an economic standpoint?
Well, think of the term DOGE, the Department of Government Efficiency. If we were to survey the entire listening base right now, I doubt there would be even a single individual would say that the government is run completely efficiently. In other words, are our tax dollars being spent ideally the way we would like them to be spent? Are there good stewards taking care of our capital? And if not, we definitely don't want to just keep raising taxes. That's not the answer. Isn't just tax American citizens to oblivion and just keep spending like a drunken sailor. That's not the answer. So what Lutnick was saying was, first thing first, let's go try to make the government spending more efficient. That's really what we need to do as a country if we're going to be competitive in the future on a global scale. Is we need to be the most efficient and productive country in the world. And first things first, let's just go cut out the waste and inefficient spending, and that will be the first step to address the imbalances in the budget and the trade deficit, and ultimately to start dealing with that Mount Everest of debt that the country has, because we're at the point where that mountain of debt is becoming, it's almost a point of no return, where we will no longer to be able to service that debt. We won't be able to make payments on that debt because it will be the largest, that the interest payments on that debt are currently, they just for the first time became the largest government expenditure. And that is close to the point of no return. It has to be dealt with. And as you said, Colin, it needs to be dealt with on both sides. It needs to be dealt with on the expenditure side and also on the revenue side. On the revenue side, two options. We can tax the American public, or we can tax our trading partners via tariffs. Those are our two answers. Those are our two solutions. Neither one of them is all that attractive, but that's just the point that we are in the world. There just aren't any really attractive options right now.
I think you said it well there. And we got a comment here, but he says tariff is a tax on consumers. And I would, in general, I would agree on that, because this cost is going to get passed down onto consumers one way or another. just like higher taxes, particularly on corporations, those tend to just get passed down to consumers. There's really no easy way. And I think that's the kind of the first point that we make. There is no easy way at this point. We are so far gone on the financial situation of the United States. When you are this far gone, there is no easy way to deal with this. There's just simply no easy way to deal with this. And you can do it a number of different ways, but the longer you put this off, the more catastrophic what could potentially happen. I mean, if we get away, John, with eventually balancing the budget, I don't think this is going to happen necessarily in 2025, but let's assume that the Trump administration comes marginally close. We probably know Elon Musk is going to be mildly successful at cutting some types of spending. Whether or not it gets to $1 trillion or more, I'm not exactly sure. I guarantee you these tariffs will bring in some money. In fact, the Trump administration has already pointed out that during his first administration, they put on tariffs, particularly on the country of China, and it brought in about $300 billion worth of, I think, money into the coffers of the United States. And President Biden actually left a lot of those tariffs on. And so there's just no easy way to do this. And if we can start to deal with it now, I would say, just sitting here as a father and having kids that will eventually be responsible for this debt, it would be nice if we start to deal with this and address it now rather than later on. Because John, look, I'm not necessarily a historian of societies and governments and those types of things, but these types of debt levels have collapsed societies in the past. I've heard discussions about the United States actually defaulting on their debt. There's been times in the past where I think our debt has been downgraded or considered for a downgrade. I mean, these things, if you continue to walk down this road, John, this is kind of like eating unhealthy, okay? Like if you eat pizza like once a week, it's probably not great for your health, but it's not terrible. But if you start eating pizza and chips and soda and candy every single day of the week for years on end, well, now you're at the point where some very, very tragic things can start to happen to you. And that's where the United States, by most accounts, get any bipartisan Democrat, Republican economists on this show, and they would tell you that this picture right here is not a good one, and it needs some addressing. Now, we can sit here. I don't think it's actually, from an investing standpoint, I don't think it's worth sitting here and saying, oh, well, they should be taxing Jeff Bezos and yachts and private jets and jet fuel and those types of things to pay this down. Because that's not the reality of the situation that we're dealing with. We are maybe if Trump was in his last year, we could have those discussions because we might have a new administration. We are not even 100 days in to a 4-year term by President Trump. We've got a long ways to go. And if this is the pace that he is setting right now, better buckle up as an investor, both from the short term and the long term perspective. But I tell you what, from a long term perspective, if they are able to deal with this United States debt situation, I know these tariffs are particularly ugly. They are going to create some higher prices on the consumer levels. They are certainly going to impact a lot of stocks, both in the short term and the medium term. But I tell you what, John, if you could start balancing the budget here in the United States, probably long term, probably freaking fantastic for stocks.
Long term, absolutely. These actions, they're well. Scott Bessent used the word detox. He said that the economy and stock market or financial market investors need to detox. And what he means is they need to detox off the stimulus from the government that was basically a blank check from the government propping up the economy and propping up the markets well beyond. It was necessary during COVID just to get us out of COVID. But then they spent trillions more than they actually should have. And so they propped up the economy artificially to the point where the debt now is not is getting to the point where it can't be serviced. Do want to break for just a second and say I've been reading your comments out there. Very, very insightful, very thought-provoking. That's pretty exciting, because that was when Colin brought the idea up to do this podcast. One of our ideas was to have thought-provoking conversation, and your responses are all very thought-provoking in their own. So thank you for sharing. Keep sharing those observations and questions, and we'll try to address them as they come up. But I read a couple of those comments, and one comment from, I believe it was from the Bullhorn, was why not do both? Why not tax the rich or the billionaires and continue, and do a less drastic version of what they're doing right now? And that's that's thought provoking. And the Bullhorn's hot mic, awesome. So well, let's address that for just a second. Tax the billionaires. They got, like Willie Sutton. They asked Willie Sutton why he robbed the banks back in the day. He said, well, that's where the money is. So why tax the billionaires? Because that's where the money is, right? They got a lot more that maybe they don't, we believe, or the public believes that they got more than they need. Well, they don't believe that they got more than they need. And they also don't believe that they need to be taxed to eternity. Maybe they would be more inclined to do so if their tax dollars were being spent more efficiently. But okay, let's get beyond that, back to a geoeconomic situation. Money travels to where it's treated most fairly or most reasonably, or where it's treated best. What that means. So I'm a former hedge fund manager. Hedge fund managers move the capital around the world to where it's going to get the greatest returns. Think of billionaires the same way. Think of them as they're just a global investor. And if you tax the billionaires, I am not a billionaire apologist here, and I'm not saying tax or don't tax them. I just want to propose this economic situation that if they do believe that they're being taxed too much, they will either change domicile, they will go get a passport from a different country, and they'll be taxed at that country's rate if it's a lower rate. Maybe if they stay, a lot of billionaires aren't gonna leave the country. They're gonna stay in the country. They love this country. But what they will do, and they have done, they did throughout history, when taxes go up, the people are getting taxed, whether it's the average American or if it's billionaires, they look for tax havens. So billionaires would be looking for tax havens instead of trying to reinvest their money into starting up new businesses, into reinvesting in something that could actually, an enterprise that could actually employ people. So if you tax the billionaires, then if you tax the people who are the drivers of industry, they're going to pull the money out of industry and put it into tax havens. And that's going to have an economic impact too. Then that's going to have an impact on employment and unemployment in the country. So it's not as simple as tax the people that have the most money and everything's going to be okay. It's a little simplified. And I'm not saying Bullhorn's hot mic that's what you were asking, because you did say, you said both. But these are complicated issues. There are no simple solutions. But it is interesting that the current president, like him or not, is the first president in decades to actually address the hard, challenging, tough issues and go at them when no other president in decades has actually done that.
It's certainly a tough situation. I mean, he is part to blame. He was part of when we show the national debt. His administration contributed to it. We can explain it away with COVID. A lot of those bills were bipartisan, yada, 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 but he was in charge during that time and did not offset any of the spending, really any of the spending with any types of or significant amounts of revenues. The one thing that I've always thought about when we're talking about like taxing the rich, we should tax excess. So if you want a yacht, I think the taxes on yachts should be extraordinary high, because I'm not going to buy a yacht. Most people in the chat, I can't speak for all of them. Most of them are probably not going to buy a yacht. But Jeff Bezos, does it really matter if the yacht is 250 million or 350 million? Probably doesn't matter to him at all. The extra $100 million, he's still going to buy the yacht. And so I would tax excess in very steep forms. I would tax private jets. I would tax private jet travel. I would tax yachts. I would tax luxury homes, not necessarily your first home, maybe even a vacation home. But if you all of a sudden own 5, 6, 7 homes, I think there would be some type of excess tax on that. Rolex watches, whatever it might be. I think you can tax. There are ways to tax billionaires where it still encourages them to have businesses, to create more jobs and more taxes and more tax revenue, but you tax the excess. And then me as a person, I'm not as impacted by that, because if you tax the crap out of billionaires, they might leave. They might go to the Cayman Islands. They might go to Puerto Rico or whatever. Whereas if we only tax their yacht, they're still going to buy that yacht no matter what. It doesn't matter. Okay. It's kind of like a penis contest between them and their other billionaire friends. They're all going to have a yacht. They're all going to fly private. They're all going to have a bigger jet every other year. Tax these darn basketball and football teams that people own. Like, tax the crap out of that. And then, maybe that will help even things out. And that's also tax I think most people can get behind. The general public, whether you're a Republican or a Democrat, you can probably get behind that type of tax. John, I'm seeing right now, after hours, we're still fluctuating a little bit, but we've got S&P 500 futures down about 3%. The NASDAQ bouncing back 3.8%. Russell, though, struggling 4.5%. I tell you what, we've gotten a lot of interesting questions. I say we address a few of them. This one saying, do you think this is still negotiation tactics, or Trump actually plans to make up for tax cuts with tariffs? So that's a really good question. So I think we're beyond negotiation now. And we played the clip of Howard Lutnick. This is to generate revenue. This is a tax, and a tax that, here's the thing to understand too. Everything that Trump is doing, he is avoiding having to pass any legislation. So he had to sign these tariffs. He had to do this under the guise of some kind of national emergency. I'm sure that's going to be tested in the courts. Somebody is going to sue him over this and challenge him. Whether or not he wins or loses, I am not exactly sure. But he actually had to put these tariffs in place under some type of national emergency. Okay. How long that goes into place, I don't know. But I fully believe what Howard Lutnick said, in that this is his job. Howard Lutnick's job is to raise $1 trillion. And this is the fastest and, dare I say, the easiest way to do that. It is very difficult to pass tax increases on wealthy people. And that's for both parties. Okay. Because President Biden could have passed some tax, maybe not, because he had a divided Congress for most of his term, but it is very difficult because there are many, many, many billionaires that are just as friendly with the Democrats as there are billionaires that are friendly with the Republicans. It is very difficult to pass tax increases, whether it's the middle class, the upper class, the 1%, or the 99%. Very difficult to do. But with a stroke of the pen, Trump can slap these tariffs on every country in the world, and he can start collecting revenue. I believe these go into place, I think, on Friday, and some other ones go into place next week. With a stroke of the pen, he can do this. This didn't have to get battled out on the Congress floor. You didn't have to get past all the stuff that you've got to get past by passing a bill. And so in some cases, this is brilliant. This is amazing. This gets to the heart of the problem very, very quickly, because this is a big problem. It's a $36 trillion problem. He got to it very, very quickly. but at the same time, obviously creates a lot of issues. I don't think these are negotiation tactics. I think I think Trump feels like he's sitting in a position of power, that he is able to do this. And I want to take a step back here, and I want to play this next clip by Howard Lutnick. And a lot of people wonder why, when we look at these tariffs on the United States, like, why do some of these nations have these massive tariffs on the United States? And I actually thought his answer was really interesting. I'm going to play that clip right now.
America was built on tariffs with no income tax. No income tax till 1913. None. Greatest, richest country in the world. So when Donald Trump says, make America great again, what he's talking about is from 1880 to 1913, when the country had so much money that we had blue ribbon commissions, which you guys would have been on, right? To try to figure out how to spend the money. Right? And no income tax. Then we put in the income tax in 1913. Why? Because we're entering World War I.
Yeah.
And don't we all need to contribute to protect democracy and to protect our way of life? Right? Then what happens is the world goes into chaos. We come out of chaos. Right? And then we're starting to think of, well, what do we do? What do we do? And then 1929, the stock market crashes. Right? 1933, we start to say, oh God, we forgot. We need to do tariffs. 1933. How can you do tariffs when the markets crash, the world's going into depression, and you're going to do tariffs in 1933? You can't charge the rest of the world money unless the rest of the world's okay.
That's right.
So it was too little, too late. Right? So then we come out of World War II. It's 1945. We need to rebuild the world. Okay? So we decide we're going to take our tariffs down. And we'll let them, here's the key, we'll let them have tariffs be up. And we will export the power of our economy to let them rebuild. And we'll let them rebuild. And that's what happened. So 1945, we have the Marshall Plan, right? And we do it in Japan, of course, because they need to be rebuilt. What's the difference, right? So they need to be rebuilt. And then what happens? We have the 50s, and we have the Korean War. So we let them rebuild, which means low tariffs here, high tariffs there. Low tariffs here, high tariffs there. Then we have the Vietnam War, right? So now all of a sudden we have all of Southeast Asia. Low tariffs here, high tariffs there. You know what the best example I can give you to make it crystal clear? Kuwait. We spend almost $100 billion freeing Kuwait, right? You know who has the highest tariffs against the United States of America? The number one country with the highest tariffs against the United States of America. Kuwait.
So John, I have an admission to make. I definitely did not get, A's and B's in history class growing up in college or high school. And so I was actually not aware of that I wouldn't say all, but some of the reasons why many of these nations have higher tariffs is because of war and conflict. Some of it, as an American, I can sit here and admit some of that was America's fault, was maybe America taking some things too far. Some of it was other countries, other dictators, other parts of the world falling apart politically, economically, and eventually through conflict. I didn't know that one of the ways that you could rebuild those nations is we would have low tariffs here. So the producers in those nations could send their goods here, and obviously their businesses, their farmers, their manufacturers, they could benefit. And then if anything from the United States was exported into those countries, it obviously come with a rather hefty tariff. And then that tariff obviously could be used to rebuild the nation. So I thought this was interesting that really the reason why many tariffs are high around the world is largely because of conflict and war. And so I think that has something to say about maybe, peace being a good thing, potentially, certainly longer term could help reduce some of these tariffs. What do you think about that? And do you think under that context, as we're looking at these incredibly high tariffs, I mean, China and Europe, Vietnam, Taiwan, Japan, these are major, in some ways, allies and obviously major trading partners with the United States. But some of the, like he brought up the example of Kuwait. Do you think under these contexts, maybe we're sitting here next week or in 15, 20 days, and Kuwait's all of a sudden brought their tariffs down? We've seen some anecdotal evidence of this, where you had Vietnam cut all tariffs, and I saw of Israel and a handful of other countries. What do you think about that these tariffs, yes, they generate revenue for the countries, but they were more or less put in place many years ago, in some cases many decades ago, to help rebuild the country from war and conflict?
That's an interesting question. And I was a political science major, and I was also unaware of what Letnick said. It's very thought-provoking. And the way I would think about it is most of the pushback that President Trump is getting now is when you use, that's a key word. They didn't just pick that word reciprocal randomly. One of them is to soften the blow, saying, "Okay, this is about getting closer to equilibrium or to balance imbalances that had existed." The fact that Letnick showed why the imbalances were there in the first place is very once again, it's very thought provoking. A lot of the pushback is coming now by the administration who is changing those relationships. So where are we starting from? If we started from scratch, there wouldn't be any tariffs. And the first country to institute a tariff would be the one criticized. The fact that we are not the first one to institute the tariff is that is bringing back some. For example, does Kuwait need to have those kind of, if those tariffs were instituted to rebuild that country? That's a pretty rich country right now. Do they still need that an economic policy that was instituted at a time that when they were trying to rebuild?
Well, I guess it's akin to, like, say you're like 18 years old and you get an allowance from your mom, and then you turn 19, 20, the allowance still comes in. You know what I mean? Like, you get used to this, right? Or like if it's like one of Elon Musk's little sugar babies or whatever, you see him, flipping out, selling his car, going crazy online because, they're used to a certain payment. And then when the payment doesn't come, or if it's not enough or whatever, you get used to the payments. Okay. So if I'm Kuwait and I've got whatever 80% tariffs or whatever they are on the United States, and the United States for the past 15, 20 years, however long it's been, hasn't done anything, it'd be like my mom writing me a check every month. It'd be like, would I call my mom and be like, "Hey mom, maybe you shouldn't send me that check anymore"? No, I'd probably just, take the direct deposit and, keep going. So at some point, the daddy or the mommy or the daddy has to cut the kid off. At some point you've got to cut your kid off. And I think we're getting to that point here in the United States with this debt. At some point, mom and dad can't afford to pay the tuition, can't afford to pay the rent, can't afford to pay the cell phone bill, can't afford to pay the insurance or whatever it happens to be. You know what I mean? Like, at some point you got to cut this off. And I think that's what we're seeing right now. And I think what will be fascinating to watch over the next several weeks is, how do the kids react? And I mean, obviously, I'm saying this kind of joking, but it's a strong analogy, I think. How do the children react? How does China react? 54% tariff, John. 54%. I know that sucks for us. And most people are probably American tuning into it. I know we've got an international audience. Shout out to the over 500 that are tuning in. Appreciate it. I understand most Americans sit here and we're thinking, I'm going to go and buy some toys for my kid. I'm going to go buy just I need a trash can, or I need something. Most of this stuff is coming from China. Some of this stuff has to come from China. There's just no other, there's no other mechanism to manufacture this stuff outside of China, particularly electronics. And so, I know we're sitting here as Americans and seeing what this means for us. But imagine, John, you own you're like Foxconn, maybe not even Foxconn. You're just one of these, tens of thousands of manufacturers that are manufacturing coloring books, or plastic toys or whatever. And you're sitting in China right now. And if these tariffs are collectible and they're, they go through and they're enforceable, my understanding is the large financial institutions are in charge of enforcing these. So the financial, money center banks are more or less in charge of enforcing these types of things. Well, if I'm a manufacturer, a mid-sized manufacturer in China, and now all of a sudden my cost of goods basically went up 54%. I mean, as much as it sucks for us here in the United States, John, how does a country that is more or less built on exports, manufacturing and exporting a good portion of those goods into the United States, but other countries as well. Now your cost of goods more or less went up 54% overnight. How did they, and I'm seeing like Nikkei futures, I mean, those things are getting absolutely hammered in the after hours. You think the S&P 500 being down 3% is rough. What's happening in some of these overseas markets is even worse. How do you think these countries balance what is happening to them? Obviously, it's hard to speculate, but is Trump in a strong position? Because as much as it sucks here in the United States that we go to Walmart and many of the prices are going to likely go up over the next several months if these tariffs stay in place, how do these other countries react?
They'll likely have to start negotiating somehow, especially the countries that are coming from a place of being that child who's been getting that allowance for longer than they actually needed it. So they'll be those will be easier negotiations. For a country like Japan, the obviously the auto tariffs are one of the most they were the most obvious in the presentation by Trump today. He had that representative from the one of the automakers give that speech. So obviously that's going to be a more tricky negotiation. But yes, absolutely, America is in a powerful position because it's the American consumer that's purchasing all of these goods. So without the American consumer, there really isn't much. A lot of countries they have very little GDP growth and actually very substantially smaller GDPs without Americans purchasing the products that they're exporting to the United States. So just thinking of that alone, that's definitely a powerful position to be negotiating from. That said, it is a global economy. And the U.S. is the lifestyle of a lot of Americans is dependent on cheaper goods that are imported from lower cost production economies and countries. And as President Trump said today, some adjustments absolutely have to be made, though. He mentioned antibiotics, for example. Almost all antibiotic medicines are manufactured, well, most of them are manufactured in China. And he said that if there happened to be a conflict, if there were to be a conflict, and they were to cut off the supply of antibiotics, that would obviously be a big problem for America. And it's not just antibiotics; it's critical minerals, rare earths. It's the supply of uranium. So those of the people that are thinking of green energy and that are fans of nuclear energy, the U.S. doesn't produce anywhere near enough uranium to supply its nuclear energy facilities. So it gets very tricky in trying to bring jobs that were outsourced to foreign countries back to the United States, or to institute these kind of tariffs. And where do you start negotiating from? But it is bringing an imbalance back to balance, and it's going to start with the countries that can most easily afford to negotiate those tariff imbalances first, and then they'll work from there. It'll be interesting to see how that plays out and how fast it plays out, because it's going to have a big impact on the chart that you're showing right now, Colin, is how long, because the longer there are uncertainties about these tariffs and about this conversation that we're having right now, the longer there are uncertainties, the longer that procurement managers and chief financial officers and those who are planning their growth plans for the next 6, 12, 18 months, the more that gets put on hold, the more likely we're going to slip not just into a recession, but a very nasty recession. The more this uncertainty, the uncertainty that's been created, the longer that stays uncertain, the longer it takes for these conversations to be negotiated into something that's going to have, first of all, a little more clarity. Second of all, a little more long-term balance where you can actually start making long-term plans. It would be very difficult if you didn't know what the cost of the products you're importing. That if you relied on imported products into your cost of goods sold, it'd be very difficult to start planning your business if you didn't know that the cost of those goods that you're importing, that you are putting in the products that you're producing, were going to be 20% more expensive, 30% more expensive, or more. That's a challenging position to be in, and you're probably not taking a whole lot of action right now. So the economy, it's already having an impact on the economy. The extent of which it does continue to have an impact on the economy will be dependent on how quickly some of these negotiations are worked out or problems are resolved. In the meantime, we're looking at these charts right now. The best that we can do, no one has a crystal ball here. We can't guess what President Trump is going to do. We can't guess how the other countries are going to respond. Is there going to be an escalation? Is there going to be a de-escalation? We don't know. So a lot of that uncertainty is currently priced into that chart right now that you're showing right on the screen. All we can look for from a trading basis and also from a long-term basis is look for technical clues where let's not try to guess ourselves. Let's try to look for clues where the big funds, like where's Goldman Sachs looking to buy? Where's Morgan Stanley looking to buy? JP Morgan? Where's BlackRock looking to buy either the S&P 500 or Google or one of the big tech companies our listeners are interested in? We can have these conversations to give us kind of a backdrop, give us like a big picture to work around, kind of a working scenario to consider, but not guess what's going to happen and not just blindly say, okay, we're down 7%, let's buy, or we've been in a correction for 6 weeks or 8 weeks or whatever it's been. This is time to buy. We'd be looking for more clearly defined clues of where the big money's trying to buy. And Colin, you do a great job on that every single Friday with your technical analysis segment on the Investor Channel.
Yeah, I'm looking at some charts right now. We got Walmart down 7% in the after hours, down to about $89. I mean, I tell you what, it's actually lower than that, $83 now in the after hours on a company like Walmart. We had a question here, and I think it kind of goes to the heart of the matter. Is, are you stepping in and, buying any of these Mag 7 stock, really put up any stock, any chart you want? Are you stepping in and buying these stocks? Are you hoping that the markets crash even more? What I would say initially to Alexander here is, first of all, hope is not an investment strategy. And just from my experience, just from trading my own money, investing my own money, waiting for something to happen, waiting for the markets to go down even further, not always a strategy that works out really well. What I would say is, when I look back on my life, and I've bought massive dips in the past. I mean, I was buying, my brother's, on the producer line as well. He remembers all the way back in 2008 and 2009 buying those dips. Everybody thought we were insane buying those dips. I don't look back and be like, man, I should have waited until, April or May after the bottom, it's hard to say when the bottom is. What I would do is just pick out some levels. And the other thing that I would say is you don't have to move in all at once. This is just great discipline. Is like, for example, I'm looking at Apple stock. Apple is obviously getting absolutely hammered because when China has a 54% tariff, obviously a lot of goods coming on the electronic space still from China. They have not been diversified into many other countries, despite Apple's best efforts getting that into India and other places. I believe India, I don't have those right off the top of my head, but the tariffs coming from India, 26%. And so Apple's goods, no matter where they're coming from, absolutely going to get blasted. Shares are down big time. I'm seeing down under $207. In fact, that's more than likely a 52-week low on Apple in the after hours. What I would do, let's just pick out Apple, pick some levels. In my technical kind of experience, my technical way of looking at these things, I set up these charts exactly how this one is. I'll switch it to maybe like a weekly view just to get an even clearer picture of this. I like to identify the long-term trend. The long-term trend with Apple obviously is straight up since about 1998. So this one has been in a long-term trend. You could say the intermediate trend is this, okay? It is also very tightly going higher, okay? And this goes back to kind of the rise of the 2020 kind of COVID era, basically the last 4 or 5 years. I like to divide these channels in half. That is when I like to start buying, but it's not all my money. Let's say I wanted 10 shares of Apple. We have literally in the after hours just crossed into what I call kind of an initial buying zone. Let's say I wanted 10 shares of Apple. Tomorrow I would buy 1 share. Now, look, do I know if the shares of Apple are going to bottom here at 207 or all the way down here at 132, which were the lows made back in December of 2022? I really don't know. What I do know is what I can control. I can control my own decision-making. I can control my own discipline. And it's just a disciplined investor to make a plan and execute. So as it relates to Apple, I would begin my buying at those levels. But the two things that you need to figure out, Alexander, before you start to make it purchases, first of all, how many shares do you want? That's the first decision that you need to come up with. And it could be mildly fluid, but I would like you look at Apple and maybe you want to invest $2,000, which would be right around 10 shares of Apple. Make that decision in advance and then come up with a game plan how you are going to get into that position. Some people go all in, all out, do one deposit and invest. That is fine. Over the long term, I don't think you are going to be, I don't think you're going to be hurt by that. But I think people that tune into this program, people that can read a chart, people that want to be a little more active in their decision making, I think you can be a little more tactical in how you make your purchases in a company like Apple. And so I would decide, hey, you want 10 shares, set up the chart any way that you want. You could put other indicators on here. John and I were playing around with Fibonacci's, which I am aware of, but look, I can't really tell you much about Fibonacci's other than when they do retrace a couple of standard deviations below the mean, they tend to reverse, and they tend to reverse rather rapidly. So you could slap something on like that on. What I do use is something called a fixed range volume profile. And so you can slap something like this on a chart. And like what John was just saying is, where is JP Morgan stepping in? Where is BlackRock stepping in? Where are the big institutional funds stepping in? With Apple, it's probably not until you get into at very first 175, just $25 lower than the after hours price, let alone $50 below the close today. And even further below that is the kind of the 140, 150 range. And so just understand that is going to create a magnet under a stock like this, is where the accumulation is. Nobody has accumulated Apple stock up in the 200s. And I say nobody, broad generalization, but the vast majority of volume, the vast majority of accumulation, just over the past couple of years, has occurred south of 175 on this one. So you can also make that determination. I'm not trying to throw like a bunch of indicators or sidestep the question. I'm just saying there's a number of different ways to answer a question like this. Like, hey, what stock should I buy? One thing that I would not try to do is pick a bottom. What I would instead do is pick levels, pick how much you want to invest in a stock, and inch into it, particularly when we're in an environment where the president can give a speech at 1 p.m. in the afternoon, and immediately after that speech, futures just absolutely tank. And as we're sitting here right now, NASDAQ has bounced back, down 3.25%. I mean, that's still a pretty big decline. Russell down over 4.6%. S&P 500 down about 3%. So, I mean, I don't think there's any easy way to answer these types of questions, but that's how I personally think about it. Have I sold any of stocks? No, I took a job a little over a year ago where I did have to sell the stocks. So I'm actually sitting in a little bit better position than normal. Is I liquidated almost my entire portfolio and I put it in a money market fund. So I had all my money the last year and a half of Joe Biden's presidency. I had it in a money market fund. So yes, I did miss out on a good run in several stocks, but I was basically sitting on cash until basically Trump got elected. And so I've started moving some of that money into these markets, into the usual names, as you can, probably imagine. Entry points depends. It totally depends on the stock. I'm looking at NVIDIA right now. That's not it. NVIDIA. I'm looking at, and John, we are on what I would call an absolute ledge of support here. The 104 level, give or take a couple of bucks, has held for about a year on NVIDIA. And it looks like tomorrow, if these after hours declines hold, NVIDIA will open up right in the 104, 102 level. If you break below that area, it is an ugly, ugly thing down south of 100, probably into the 80s with NVIDIA. And so it really is, what I would say is it's probably sector dependent, because I had the Berkshire Hathaway chart up here, and that looks absolutely fantastic still. As you can imagine, Warren Buffett probably sitting back on his, I think he has a couple $100 billion worth of cash. He's probably sitting back and doing pretty well. You look at a stock like Google, which has had a rapid sell-off. My goodness, this is an absolute rapid sell-off from the highs that you made literally back in February. We're talking, what was that, 2 months ago? Not even that. 23%, John. 23% drawdown on Google, which doesn't happen. You have these drawdowns. You had a 23% drawdown here from the end of 2024 or mid 2024 into September. And ironically, right at 23%, it bounced back. Google is moving into a range where it's a buy, but it's still above the long-term trend. That's what's so incredible, is the move we've had off of COVID and really off of, the Biden eras, particularly the last 2 years, was actually pretty good. Many of these stocks are still well above trend. Amazon's probably not quite in that area, but I mean, we still made a beautiful move on Amazon, and Amazon is just pulling back. John, I mean, we have so much to talk about. We could literally be talking about Amazon potentially buying TikTok. When I saw that, did you see that headline?
Yeah, that gets really intriguing, doesn't it?
I mean, we've got these tariffs, which is obviously a huge story, at least in the shorter term. But I think over the next couple of days, I believe April 5th is the deadline. Now, that deadline could get pushed back. But we have many companies. I saw AppLovin threw in a bid for TikTok US. I tell you what, you could have a company like Amazon transform their entire business. And then they're not going to buy all of TikTok, but anybody that gets control of TikTok US, particularly Amazon. Very, very interesting. So entry points, I tell you what, I would say on some stocks, even like if we're looking at like Costco is still way above. Like, look at the Costco chart. Like, it is still, in my opinion, way above trend. I mean, it is in trend still, but it is well above trend. Walmart was the same thing. We were obviously seeing Walmart pull back when you got 54% tariff on China. But look at Walmart. Walmart, if you zoom out, it is still what I would consider way above. This is still way above trend. So some of these stocks, in my opinion, have just priced in, sunshines and roses. and it was due for a pullback. So if you're holding these stocks, this is not a time to panic at all. I would lose the password to your long-term account. So if you have a retirement account and you're my age and younger or even slightly older, just lose the password. Don't even log in. You know what I mean? The only thing to do with your longer term account, some of you guys have, like W-2 jobs where every month they're pulling from your account. You should be able to log into your HR or log into your Fidelity and bump up your contribution. If you're doing 5% of your check, bump it up to 7, cut back on something. You know what I mean? Like cut back on something, or, figure out a way to, supplement your income to make up for that 1 or 2% bump. But this is the time. One stock that oddly enough, John, that I wanted to look at was eBay, because I'm thinking here's a weird thought. Okay. We're going off the rails here. We're an hour in. Shout out to we got 650 people watching. Shout out to all of you guys. Appreciate it. Here's a weird thought for you, John. You tell me what you think about this. So we've got these fat tariffs. If these stay in place, the price of goods goes up across the board. What does that make more competitive? Is probably some of the goods on eBay, because they're not subject to the tariff, right? If I've got a widget here in my room that has some value, that all of a sudden now, because of the 54% tariffs, a new version of that widget is now 54% higher if this tariff is passed on dollar for dollar. So now all of a sudden, eBay's prices become maybe slightly more attractive because these goods have more or less absorbed that tariff and are not subject to it. Do you have any thoughts? Is that a viable thought process that I have there?
That's a great thought process, because you asked a question earlier, which was, what am I doing in the current environment? So I've been trading independently before I started teaching and writing reports for the public. I was trading independently for the better part of 20 years. There were 2 really wicked bear markets during that period, and I was able to make money in both of those periods by selling short at first, which we're not really going to get into on this particular episode, but it was largely being really sitting in cash for a lot of the corrective for the better part of months, or even like almost the entire full year of 2008, and then getting some opportunities to buy some really, really high quality companies at really cheap prices. So that is something to consider in these kind of environments. When you bring up eBay, the way we interact, for those of you viewers who don't understand our business relationship, Colin's primarily the big cap stock expert, and I've been focusing on small cap companies for most of my 35 plus years in the stock market. And there are amazing opportunities that pop up in bear markets to make enormous amounts of money, or just to make a little bit of money in a bear market, which is actually a major accomplishment. So can you make a little bit of money in a bear market? How do you do it? Sit in cash, be opportunistic, or find a name like an eBay. I posted on same kind of thinking. I posted a name on Twitter last week. It was a pawn shop operator, EZPW. Yeah, pawn shops are boom. The demand at pawn shops is through the roof right now. So there are opportunities to be very selective. And Colin and I had a great conversation just a couple days ago, and it was about the most of the financial education the investing public gets is first of all, you need to be diversified. You need to own a huge portfolio of names, or you need to be in a mutual fund, or you just need to buy the S&P 500 index. And that way, if one company underperforms, then it's not going to wipe you out. That's for most people, that's a good idea. Just put your money in the S&P 500, dollar cost average, put a little bit of money in every single month. If you are trying to take the matter into your hands, if you're trying to get a little more financial education, try to learn a little bit more about selecting individual stocks. There are a lot of dogs in the S&P 500. That Russell 2000 index is the 2000 of the smallest of the Russell 3000. So there's 1,000 company stocks that are bigger than the Russell 2000, all the companies in the Russell 2000 index. In the Russell 2000 index, more than half of them are losing money. Most of the Russell 2000 index is garbage, okay? You can kind of screen most of that out. But there are also some great opportunities in there. And they become amazing opportunities in periods like we have right now that you can take advantage of. And then there's some companies that are counter-cyclical. They're counter-recessionary. It's where money flows into when the market goes down. And then there's other companies like Colin, like you just showed, that eBay, like look for opportunities. Like when the environment changes, you got to think differently. These are different kind of names than we normally think. The money I made in bear markets in the past were not the names that made me all the money in the bull market. They're completely different names I wouldn't have even considered while the market was rising. I wouldn't have considered buying a pawn shop operator last year. It was all about AI and semiconductors and the fastest growing companies. So you got to be a little creative. But you don't need to be all that diversified. You don't need to run your personal portfolio like a portfolio manager. So when I was a portfolio manager, I had a mandate where I had to own a large number of companies to be diversified. That's what my clients that's what my clients asked of me. As an individual, think of the word, let's use a word that Warren Buffett uses. He thinks that most individual investors, when they're overly diversified, he calls it diversification. Like the more names you have in your portfolio, first of all, you can't, how do you, if I get up to, call it like up to 10 names in my portfolio, then I'm not following each one of them close enough. So you can be diversified, or you could have too many names in your portfolio where you just don't know them that well. And it doesn't make any sense to be diversified into names that you don't know that well. So there's a lot of opportunities and strategies in markets like this. Hopefully, we have plans to have more conversations about some of those strategies, and we will be sharing those on Substack and other podcasts in the future. But
at some
I
point,
love that. I love your idea. But you got to be creative.
I do want to be clear.
Yeah.
I'm definitely not recommending going out and buying eBay, even though over the last year it is up 30%. My thought process is if I'm sitting around my house and I want to deposit more money to invest in these markets that are selling off, I am looking around my house for stuff that I can sell on eBay, and I'm snapping a picture. Now, it might benefit eBay a little bit, certainly more than like an Amazon. And in times of recession, times of struggle, people sell stuff, and obviously one of the first places you'll go is in eBay. I just know that eBay is one of these companies that, like, if I were to buy eBay, it's certainly not in my retirement portfolio. I think eBay will be around, but it's one of these stocks where you stretch the performance out. Well, it actually is better than I thought, but over the past 10 years, you're up only 17% on this one. So it's like, it's been up or down, up or down. You've had to time this one very, very right. So I would just say with eBay, your timing has to be correctly. I'm looking in the after hours, John. Meta is sitting on what I would consider kind of a longer term or intermediate longer term trend here. And, if you break here, you're going down, south of 500. What I would say with Meta that is interesting is that Google's search business is, I think we can all agree, is being disrupted. And it's hard to sit here and wonder where the traditional search business, click on an advertisement business, is going to be in a couple of years. With AI, with Perplexity, with Grok, with standalone AI apps, with Meta likely rolling out their own and rolling that stuff out natively in an Instagram, YouTube. One thing that makes me excited a little bit about Meta is their business is not being disrupted enough. And I'm just speaking from an advertiser's perspective. I know that if I'm spending, and I do spend money on search engine ads, if those stop performing or I don't get as many clicks as I used to, I'm probably turning around and I'm dumping that money into Meta. And so I believe, shorter term with all this tariff stuff, things happen. And obviously these tariffs are probably not good for the advertising business in the short term, but long term, the more Google is disrupted, the more of that money is actually going to flow over into Meta. Entry points. Watch the Friday show, I would say. What do we buy tomorrow? Gosh, I think here's what I would do. If you're a long-term guy, you do what I say, and I would bump up your contributions. If you're in a semi self-directed one at your work, bump up your contributions as high as you possibly can go and try to leave them there. I try to raise I do raise mine every year. I put money into an account for my sons, and every year I bump it up. I have money that I set aside. Every year I bump it up. And it's just something that I've done for a really, really long period of time. And you just get used to it. You just get used to that money leaving your account, and then you bump it up every year. It's slightly painful for maybe that 1 month, but then you get used to it. So I would do that. What do you buy tomorrow? If you're a long-term guy, you buy a set of golf clubs, and you go get some hobbies, and you don't pay attention to any of this. Because here's the deal. Trump, yes, he's got 4 long years, depending on how you want to look at this. Got 4 years left. Really, actually, it's like 3. He's got 3 years left. It's actually not that long of a time frame if we're talking about somebody that is going to hold their stock portfolio for the next 10, 15, 20, 25 years. 3 years is nothing. And so you should welcome any types of pullbacks. You should, I wouldn't say blindly buy them, but I outlined this strategy early where you pick out some levels and you start inching into these types of things. If it's an automatic thing, automatically gets dumped into the mutual funds or the Fidelity funds or the Vanguard funds, just continue to do that. And I would bump up my contributions. I would lose the password to my retirement account. I would not look at it going up or down at all if I had a 25-year time horizon. On the flip side, if I was 65, 70, and I think that's some of the price action that we're seeing right now, those people have to sidestep all of this. I mean, what Trump is doing, this is absolutely extraordinary. And depending on how you look at it, it's either extraordinarily good that we have a president actually trying to address this national debt. Now, I don't think he communicated that well at all during his press conference today. And in some ways, I think Trump is a good communicator. In some ways, I recognize that he is a terrible, absolutely terrible communicator. Okay. He is both great and, he is very polarizing in a lot of ways, including his communication. And I'm not talking about how people receive it. I'm talking about his communication style in some ways is very effective and then some ways very ineffective. And this holding up of this graph and bringing up union workers and all these types of things, I appreciate those people's work, but this was not effective, which we played earlier. The goal is to raise $1 trillion in new revenue. The way they're going to do that is through these tariffs. And then Elon Musk is going to cut $1 trillion. And when you do that, if and when you do that, you will have a balanced budget in the United States, which I am not a presidential historian, but I don't think that has occurred since Bill Clinton, which for many of you was a very, very long time ago. But in my opinion, Bill Clinton economically was probably the last great president that we had. Economically, he was absolutely sound. He reduced the size of the government. In fact, one of his famous speech was, "The era of big government is over." And how ironic that statement was, is the era of big government actually was just beginning with the Bush era and 9/11, with Obama, with the great financial crisis, with Trump, with COVID, and then Biden with inflation. The era of big government was just actually beginning. And can we get back to a balanced budget? We'll see if they're able to do that. Interested on our take on the tariffs and supply chains in the semiconductor industry. That's a great question. So Taiwan has 32% tariffs, although from my research is that 32% doesn't necessarily apply to the semiconductor industry. I believe a reduced tariff of around 20% does apply. Now, this stuff is fluid. This stuff is going to change, I think, hour by hour, day by day. But my understanding, when I looked into this before we stepped on here, is that there is a tariff on the semiconductor industry, but that would likely be absorbed primarily at the producer level, the TSM level, and then also at the NVIDIA level. When NVIDIA has 75% gross margins, they can probably absorb some of the tariff. Also, their customers are not you and I. That's Google, which although Google stock is down, they have $90 billion sitting on their balance sheet. I saw earlier this week, there were rumors that Apple was going to buy, I think, several $1 billion worth of NVIDIA GPUs. Apple has plenty of money, and so they can afford it. And so as it relates to semiconductors, I think there's probably some impact. I think this only accelerates the importance of AI and the investing there. And I think this only accelerates the investment. I know, as crazy as that sounds, I think this only accelerates these companies and their desires to continue to invest there. Because in a world of tariffs, you need robots, you need efficiencies, you need all this type of stuff. This question says, if you had 10K to invest, I'd probably buy the new Rolexes, which came out earlier this week. Although most of them are cost more than 10 grand. Next few months or quarters, how should you go about it? That's probably a John question. John, you got 10K to play with, and you're trying to, invest it over the next few months or quarters. If you're talking long-term, just, dollar. I know this is like, nobody tunes in to have me give you Warren fucking Buffett advice, but I would just say dollar cost average into, whether it's, if you're index fund, dollar cost average into that. If you like Apple, NVIDIA, Microsoft, any of these companies, just continue to inch into that with your 10K. That's how personally, like, I'm not even really speaking for you. I'm talking about how I'm doing this. That is what I'm going to do over the next months or quarters. Now, I have a longer term view. I also am trained when my stocks go down. It's like a sale at Rolex. I am not upset when the Rolex authorized dealer says, hey, Colin, instead of $12,000, the Rolex is now 11. I'm happy. I'm happy. Same thing with these stocks. When I'm looking at Meta here, I bought Meta at 600. Now in the after hours, it's 555. So one way to look at it is, oh gosh, darn it, I should have waited. No, that's my disciplined way of investing. And maybe that method gets blown up by Donald Trump. I don't know. It's possible that method gets blown up. But, I've been investing for a long time, and I've seen 9/11, great financial crisis, COVID. I mean, COVID was ridiculous. And the strategy has worked every time. And look, maybe one time it won't, but until I am proven wrong, that's the strategy I'm going to go with. Short term, John, are you in there day trading 10K? Or are you, like, I think I asked you right off the jump. I mean, I don't trade these markets. I hate it when somebody can do what Trump did and the markets react to it. I just can't. My chart doesn't tell me anything about this. It's hard for me to find indicators that can predict this, right? But when markets are boring and the president is half dead and they're just like marching higher, I love trading those markets. I love trading when there's no political news. All the news is known. The earnings are pretty much locked in stone. I love trading that because it's like predictable. With Donald Trump, my goodness. Do you have a different opinion than that?
It's not really different than that. I especially agree with you about in a bull market, you can basically find the top performing stocks by relative strength, and the big names. Everyone will know the names that are acting the best, and you can pretty much buy any dip or even buy breakouts along the way up. I do catch them at the start of the uptrend, which was which you could have identified using technical analysis from the low of September, October of 2022, which gave amazing entry points using technical analysis. And then when it came around December, January, just a few months ago, in a lot of these, exactly like that, you get your
This is that pawn shop. So this is easy PW, and to me, novice chart guy, but I'm seeing an area of resistance that has held for, my goodness, this is like a 20-year resistance level at like 15 on the stock. And here you are butting against this. So what John is talking about is a breakout. And you might be able to speak to this in more detail than I can, but typically you're waiting for kind of closes above this. And then, I mean, it's almost like an Elon Musk rocket. When you get these breakouts, the next area, I mean, there's a lot of areas along there, but the top end is all the way back up at 40. So this one could go from like 18 to 40 on a breakout. Not saying that it will, but this is a type of chart that you're looking for. And it could be fundamentally as well with the pawn shops that, look, Trump doing this, maybe I need a little bit more money because all the stuff is more expensive. And so I'm going to the pawn shop and donking off my goods. This is, you're looking for a breakout here. It's also a low, in my opinion, kind of a low risk trade. You buy in at some level, you set your stop loss very much underneath the level of resistance, because this thing is either going to get rejected back down like it has for the past 20 years, or it is going to break out. And so you have this very binary action as it relates to this trade. Also in kind of the micro trend, really the last 4 years. I mean, this is a beautiful series of higher highs, higher lows. I mean, this chart, EZPW. I mean, this is why we have you on, John, because I've never even heard of EZPW. I would have think that's some kind of like, I mean, I don't know. Maybe I shouldn't say, but EZPW. Yeah. I mean, is that what you're seeing on that chart like that? Is this poised for potentially a breakout?
Yeah, that's exactly the way I look at it, which is you can, and we'll get into some more trading strategies over the coming months that you can apply, both in terms of identifying trend reversals, and either breakout strategies or pullback strategies. And this one could apply either way. It could be a potential breakout. It could be it breaks out and you haven't got into it yet, pulls back if it were to do that, you just watch it. See if it does break out, then we have a uptrend continuation. A pull back to that breakout point could be an ideal entry point. And the most important thing you mentioned, Colin, on a trading basis was putting that protective stop just below there, so exactly you have and most traders, I'd say probably like 90% of traders, when they first start trading, they have a upside target and it's somewhere near the moon, and they have no idea what to do when it goes the opposite direction, and then they just hold on to it, and a short-term trade turns into a long-term investment, and you never want that to happen. So having that protective stop, a clearly defined dollar amount that you want to that you're willing to lose, and never enter a trade unless it has more reward potential than downside. And that's a strategy that applies to both the short-term trades and also to every name that you talk about every Friday with the big cap stocks, which is, these companies have, maybe they do have 10% or 15% more downside. But when things do turn, those big, high quality, dominant companies are going to head much, much higher than the 10-15% downside that they may still have in them.
Yeah, exactly. I mean, to describe that trade, if you miss the breakout, which would be this big green candle, what often happens is a back test to the previous highs. That is a setup I absolutely love. Now, I like it more to a breakout of all-time highs, but these all-time highs occurred so long ago. This was back in 2011. So these highs were so long ago. You're breaking out really above the 2018 highs. But if you miss the initial breakout, there is a back test to trend, and then you come back to make a new higher high. This is if you have your trading hat on, this is what you're looking for, is this type of thing.
Change the symbol. That could be anything. If you're looking at that technical formation right there, it could have been NVIDIA last August. It did something very similar to that exact same trade. You see that formation, doesn't even really matter what the symbol is. Yeah.
Right. Now, the key thing is, John said, if you're going to trade, it is like if you play golf, you understand that you need to learn how to chip out of the woods. So if you hit your ball into the trees, what a lot of people try to do is they try to play a hero shot and they try to hit it around the tree or hit a low, high hook or whatever it is. Don't do that. Take your medicine and, cut your losses on this one. I'd have a stop loss on this one in like the 1440, 1450. I'd play $1 to the downside with like 6+ to the upside is how I would set that one up.
Beautiful.
That one looks pretty good.
The
With all the tariff,
the nerdy technical analysis term for that is an asymmetric trade, where the reward potential is multiples of the risk.
I don't know why. I hate that.
I didn't even want to bring it up, but
I hate that term. Like, I don't know. There was a guy I remember arguing with on Seeking Alpha, and like his name or his whole thing was asymmetric trades. And it was like, bro, all your asymmetric trades basically go down. Like, you don't know, like if you are going to be an asymmetrical investor, you are probably going to sell, like you're going to sell at a loss, like a good percentage of the time, like double-digit percent of the time. Because, like a lot of times it's not going to go the way you think. But most of these guys, they're like, oh, I'm an asymmetric investor. And they bag hold on 40, 50, 60, 70% of their portfolio. And then, oh yeah, one goes to the moon. But it's like, yeah, you held the bag on like 4 other stocks and lost all your money. With all this tariff talk and the market response, what sector or stocks do you think will benefit the most from all of this volatility? I tell you what, I mean, a lot of people are going to be pointing towards gold, but the time to buy gold was a long time ago, I believe, probably when the whole inflation talk started up. And I think it's still, I don't want to sidestep this question, but I believe that, boy, we are early in understanding what is happening here. I mean, Trump came out to trumpets. He's throwing out hats. I mean, he is in a different universe here. Also, the way this is being covered is in a different universe, because what Trump did today was all in the context of trying to raise $1 trillion of new revenue and cut spending by $1 trillion to balance the budget. I don't care if you're a Democrat or Republican, an independent. If you run on balancing the budget, I would listen to you. I don't care if you're AOC, Bernie Sanders, or Donald Trump. If you run on that platform and you have a clear way to get to that result, I would listen to you and I would consider voting for you. Trump did not run on balancing the budget. He is also not communicating that he's balancing the budget. Only when you go to the weeds, and I mean, Howard Lutnick's interview with All In Podcast has like 1 million views. So it's not quite the weeds. But the whole goal of these tariffs is to balance the budget. And so to answer this question, if we get a balanced budget here in the United States, this is fantastic. This is unbelievable. I was actually not expecting Trump to address this in his first 90 days, let alone in his last 3.5 years in office. I was not expecting him to get to this. I was expecting him to get to the border, expecting him to talk tough on China, expecting him to deal with Russia and Ukraine, expecting him to deal with like woke stuff or whatever. I was expecting him to deal with that stuff. And he has, more or less. I was not expecting him to balance the budget, but that is the plan. And if they are able to do that, it's probably a good thing. Jojo, can we consider Doge and Liberation Day as I can't say that word, crisis from which we could emerge with new all-time highs? Imagine Trump put just around the corner and first signs of a recession. Jojo, it's a great question. So he's wondering, like, look, could we have a little bit of a stomach ache here? And then the Fed comes and bails things out? That is possible. That is possible. If he's able to balance here's what I would say, Jojo, is the end game is they're going to try to balance the budget. And the very interesting thing, this is what I don't see anybody talking about. They're literally trying to balance the budget without Congress or the Senate acting. So they're trying to do this without any of that. They're also likely to pass the extension of the tax cuts. It's basically the tax cuts that are put in place during the original Trump administration, which really benefited, yes, it benefited wealthy taxpayers, but more or less, I pay my own taxes. I know tax law a little bit. It did benefit. I'm not a 1% guy. And so it did benefit most taxpayers. Okay. And most of the data out there shows that. And so I tell you what, the goal is to extend those tax cuts, but also Howard Lutnick, which I didn't play a clip here, but they want to, Trump ran on reducing tax on tips, reducing tax on overtime, or eliminating tax on these things. And what he's also now floating is eliminating tax on anybody that makes $150,000 a year, which I believe the stats show is like 80% of taxpayers. And so, yes, you might have, not might, you will, if these tariffs stay in place as written here, you will see higher prices. But it could potentially be offset a little bit by tax cuts, lower taxes. And I believe longer term, the markets are more or less rigged to go up. And I think longer term, if the United States deals with this problem right here, the national debt, the sooner they deal with that, the brighter and more clear the future is. The longer you don't deal with this, then it really, I mean, you wonder about not only, like, for me, not only my children. I mean, I'll be dead when my children have to deal with like $100 trillion in debt. So it's their problem at that point. But this amount of debt I might have to deal with, right? I'm like I'm not that old. And so I might, I get into retirement and then the United States starts defaulting and collapsing. That would be a miserable way to live, right? So the sooner they deal with this, I think the better. John is wondering if we have any thoughts on key indicators to look for in the retail sector bounce back. Curious about opportunities around my favorite stock is Amazon. My favorite stock is Amazon, not just because they might buy TikTok, but because they're going to replace 1 million workers over the next 10 years with robots, and that should be great for the bottom line. I think you're pulling into a buying zone with Amazon. Previous consolidation is between 150 and 180 in the after hours on Amazon. You are at $184. So you're right on the top of that. So I wouldn't say Amazon is a smoking hot buy at these levels, but it is now in that, what I would say, in that ballpark. And I just think longer term with Amazon, you're consolidating around 4 retailers here in the United States: Costco, Target, Amazon, and Walmart. So you have 4 retailers in the United States. And, look, in a consumer driven society, I would love to own retail stocks at the right price. And so retail, I think XRT is retail, right? XRT.
Yep.
So if you wanted to buy a basket of retail, looks like rock bottom support is at 55. It's currently in the 70s, probably in the after hours, the 60s. I mean, it looks okay, but you just made a high and confirmed a lower high. So this chart, broader retail looks, I mean, I don't know, John, what do you think about this chart?
Like you just said, just a trend, reading the trend, you got a lower high. The low is yet to be determined. And it doesn't look like there's any major, we do have like a minor support that we're at right now, which we're kind of at
right here.
Right, yep. And then the major support was where the line was previously.
Yeah. So I don't like broader retail, only because here's the deal, John, is like, I don't, like I said, the United States is consolidating around 4 retailers. And so I don't like anything other than Costco, Walmart, Target, Amazon. And so I don't want to play the basket, buy the ETF. Now, I don't, without bringing up the holdings on this, it could be that they're, like 80% of the fund is in those 4 stocks. I'm not sure, but my guess is you have a little bit of Home Depot. I am bullish Home Depot and Lowe's. Look at Home Depot. Look at that Home Depot chart. I mean, look where you are there. That is beautiful, in my opinion. I mean, this is fantastic. Could it break lower from there? Yeah, but I like Home Depot and Lowe's primarily because They're, if we're talking about the quadrant of retail, general merchandise retail, it's obviously Costco, Amazon, Walmart, Target. If we're talking about the duopoly of home improvement retail, it is Lowe's and Home Depot. So if I were to build a retail portfolio, and in my portfolio, I ignore Target, not because I'm like anti-Target, just never. Target stock, if you look at it, is like crazy volatile. Like this thing was like at 265 and now it's at 100. So like, I don't know. I mean, it is starting to pull back into like an interesting area, but boy, you've had such a massive sell-off on this one. So a little harder for me. I love like the chart of Costco. Like, John, is it really complicated to figure out where to buy on a chart like that? I mean, this is such a, I'm a no-brainer investor, John. Like, I like to play golf. I like to watch chess videos. I like to watch the San Francisco Giants and the Lakers. I don't really want to make hard decisions. And I look at a chart like this, and when it's at the bottom of the channel, it is a buy. It has been that way since 1986, John. John, I was 4 years old in 1986. So for my entire life, this chart has bounced off a very reliable level. And when it gets there, I buy it. I'm a simple man. When it gets to that level, I buy. I don't know. With Costco, I don't wait all the way to the bottom. I tend to accumulate these things in the middle. Last time I bought this stock, I actually bought it for my kids back in 2023. It's probably their best performing stock in the group. Walmart, similar type of chart. Bring up Walmart. I mean, it's had a few more, and it's had more sideways consolidation than Costco, but the Walmart chart is similar. The Target chart is just, I can't judge that. And Amazon obviously has a lot more going on business model wise. And so if I were to position myself in retail, Amazon, Walmart, Costco, Home Depot, Lowe's is how I would position myself in retail. And then as these tariffs drive the prices and the revenues and the profit margins of those stocks down, because these will have a dramatic impact on all of those stocks. As those stocks pull back, I'm a buyer, simply because it will only help consolidate retail any further. If Joann's and Big Lots and Party City, across, the dozens of other retailers that have gone bankrupt over the past 5 or 10 years, if they struggled before the tariffs, my God, retail is going to get killed by these tariffs. But we know that the spend will consolidate at Costco. Like, I'm shopping more at Costco. Okay. I'm like the least price sensitive guy in the world, but I literally will go to Costco in a Tesla and I'll have a Rolex on, and I'm buying groceries there because I'm saying it's $8 for a goddamn box of cereal around the corner for me. So yeah, I'll drive across the city 10 minutes to go to Costco so I can save $4 on the box. You know what I mean? Like, yeah, I'm not price sensitive, but I'm not an idiot. Colin, should we average? Oh, Nike. Yeah, this one's in the after. What do you think Nike's down in the after hours? My God. Oh my God, it's down. It's down 7.3%, down to $60. Nike's just going to get hammered. Now, there's conflicting reports. I have Vietnam cut all tariffs on American goods. Now, that's American goods going into Vietnam. But Vietnam did this to remove the 46% tariff. And I only bring up Vietnam because a fair amount of Nike's goods come from Vietnam. So yeah, Nike goods are subject to a 46% tariff, but my understanding is that should get negotiated. This is broken out of a longer term trend. This is really not good. This is not good. But there's areas of support where it is. I don't know. Here's my long-term thesis on Nike is 20 years from now. I'll ask this question to you, John. 20 years from now, people still wearing Nike?
Yes.
Okay. So that's it.
It's not like that's it. That's one of those very simplify it. Keep that one simple. Yeah.
Now, if I had if I have a $10,000 portfolio, how much percent is in Nike? Not a huge percentage. Like, I don't want to be exposed to this name. I don't want this to be half of my portfolio. Now, this has grown to a larger position inside. I'm just speaking me personally. This has grown to a large position inside of my portfolio only because I've held it for a long time. Like, I literally started buying this stock when it was like in the single digits. So over time, obviously the splits and the dividends, and like, I just got a dividend the other day. It was like a massive amount of buy. Like I picked up an extra like 40 shares or something. Like, so the dividend payments are really good. And so I continue to hold it for that. And I hold it for John's answer that, yeah, 20 years from now, people are still going to buy the shoes. And so I think you're going to be okay. But I wouldn't have it be a large position in your portfolio. Dark. It's getting dark. 7:15 out here on the West Coast, 10:15 on the East Coast. John, we have over 700 people tuning in today. It's our first live stream, so this is just a dry run. Thoughts on capping credit card interest rates at 10%? I think it's a terrible idea. As an investor in JP Morgan and Wells Fargo and Bank of America, I think it's a terrible idea from that standpoint. I also think it reduces, here's real short answer to this. I think it reduces the access to credit to the people that need it the most. Okay. Now, should the average person be running up credit card debt to 20 on a 25% credit card? No. Okay. So there's probably some financial literacy. There's probably some things we can do from that perspective. But if you cap credit card interest rates at 10%, it means only the 1% are going to get access to credit. And it is only going to make inequality even bigger. Like, if you can imagine, like, the inequality would get even larger in the United States if you capped interest rates at 10% on cards, because it would only mean people with great credit scores, great credit, that don't even need the access to the credit would get access to it. Now, could the JP Morgans and the Wells Fargos, could they do more creative things to help borrowers that are maybe overextended or those types of things? Yes. And I actually think those days are coming. Part of the plan rolled out by the Trump administration is to reduce the deficit that the United States government takes on and actually pass that on to the private sector. So instead of, these Doge companies and these government employees absorbing a lot of the spend and the taxpayer money, that is going to be passed down to the consumer and the businesses. And that, instead of the government running something, then it's going to be the private sector running that. And so part of the plan is to have the JP Morgans, have the Wells Fargos recapitalize and loan money. That's just a fancy way of saying they loan money to businesses. And in that environment, you get a little bit more creative on the financial side. Somebody brought up Robinhood. We'll talk about that in here in a second. But the Robinhoods, the SoFis, the Upstart Financials, these companies will get more creative. And the firms, the buy now, pay later stuff, they'll get more creative. And in an environment where credit is really flowing through the private markets, we saw it during COVID. Like, John, you could click a button on your phone and get like $10,000 at like 0%. Like, it was like, like, I was running an inventory business at the time. I was selling stuff on Amazon, and it was like literally Amazon would just say, hey, click this button, and based on your sales, we'll give you $15,000 at like 4%. And so it was like, yeah, I'll take $15,000 at 4%, click. And the money would like literally, it would just come off your sales. And it was like, when your profit margins during COVID on a lot of the stuff I was selling was like north of 20%. So yeah, of course, I'm going to borrow money at 4% and sell at 20%. Like, it was like I felt like I was JP Morgan. You know what I mean? I had money coming in at 4% and it was going out at 20. I felt like a genius, right? And so like in that environment, yeah, like, you have more access to credit. Now, I went off on a side tangent, but just broadly speaking, and I could be wrong about this, I've heard the counter arguments to these things. I certainly think they're valid, but no, I would not cap interest rates at 10%. I think it'd be a terrible idea. Super chat, John, $6.99 Canadian, coming in from Intensive. Thank you, my man. $6.99 Canadian. It's fantastic. Thanks for making this live. I'm waiting for my upcoming paycheck. Awesome. To buy more discounted stocks. I hope that this is not turning into a chapter 711 on the United States. I tell you what, I got the debt clock up. The longer we wait, it would turn into that.
Look how fast that thing is moving. It's moving like $1 million in less than a minute.
Yeah, it's gone up. Several million. Since we've been on here for about an hour and a half or so. I'll just reiterate something that I said. The longer that the United States didn't deal with this, the more it became a dire situation where, yeah, we were going to pull our money out and go buy some gold bars and put them under the mattress. And that's what we were going to do because it was dire. Not saying that those days are over, but the sooner you address this, the better. And I don't care if it's Joe Biden or the next administration, if they tax Jeff Bezos and Elon Musk, or if they're doing tariffs or they're doing something else, I don't mind. I actually don't mind that the problem is getting addressed now, because like I said, when this becomes a big problem is like when I'm retired, and I definitely don't want it showing up there. That'd be terrible. John Blake, guy's just such a loyal fan of the show for a long time. Do you think this administration's plan should change the focus of the next investing strategy, moving from the Mag 7 to something else? Or does it not matter long term? John, I know my thoughts on this. What do you think?
Not at all. There has been. It's interesting. If you pull up the sector performance of the S&P 500 since the beginning of the year, it will show you that the Mag 7 is down. There are communications are down, but it will show that some sectors that are actually exposed to the tariffs are actually still up for the year. And there is one sector that's up for the year. The basic materials sector is up for the year, and that is obviously exposed to a potential economic recession. So it's almost as if that investors have simply taken. A lot of these stocks were up north of 100% in the course of 18 months or so. And so what a big fund manager does is they will do something called sector allocation. They'll sell a little bit of Apple, Amazon, Netflix, Google, just as a sector allocation, and they'll reallocate it to other parts of the S&P 500 that were previously underperforming. And that's the kind of thing that's been happening largely since the beginning of the year. So a lot of the price movement has been just basically decision-making from the big funds of moving money out of tech and into other underperforming sectors. Now, I don't think that this changes the outlook, and Colin has way deeper insights because he follows them every single week, and he knows the nuance and the little ins and outs in all the recent developments of those companies. One of the reasons I'm here on this channel today is because I believe that Colin is one of the most foremost experts in big cap investing, primarily in Magnificent Seven names, and he helps me get ideas on which kind of small cap companies to look for. And as a team, we just kind of knock it out of the park. But I don't think that this current administration needs for you to change something, maybe even in the intermediate term, but definitely not the longer term. And Colin not only has shared some insights of things that are coming regarding robotics and AI and various different future developments, but those are going to be potential, especially on Amazon. I just like maybe if this is going to be recorded, to rewind to what Colin said about robotics and Amazon. That is like a game changer, and that's like a franchise maker in itself. So those are the kind of things that would definitely cause me not to change my investment strategy over the long term, regardless of what our president had to say today.
Yeah, so I've got a sector heat map on here, year-to-date percentage. It definitely looks like to me, not knowing any better, but I'm pretty sure like healthcare stocks have kind of been shitty for a little while. You've had a little bit of a rotation into that. Obviously, Lilly with their weight loss drugs. Novo, I don't necessarily think is represented on here, but that stock like has ripped. Johnson & Johnson's up. Berkshire has gotten like kind of a bid. I know Visa and MasterCard have held up very, very nicely, which is kind of interesting. If you're moving into a recession, there's maybe lower payment volumes, but they're doing fine. I think you just have, these stocks had moved so much so fast that, they had to take a breather. It's hard for Nvidia at a, I don't know what the valuation is right now, but it was like at 3 trillion. I remember I was like, what is it got to do to get to 6 trillion? Now you're sitting at 2.7. I think at the very least, it allows Blackwell to tack on, get us back to a 3 trillion valuation, which would be like a 10% or more move on this stock. So this is allowing for that performance to come back with all of these stocks. And I would just get back all the way to the fundamentals when you're looking at all of these stocks, in particular, Apple, Nvidia, Google, Microsoft, Meta, and these stocks have, tens of billions of dollars. In fact, they have so much money, they don't even know what to do with it. They're buying back the stock so rapidly. So I like stocks. I like stocks in that position. They continue to raise the dividend, those types of things. When is the paid service coming out? That is a good question. Very soon. I feel like Elon Musk a little bit, where I've said, oh, it's going to be here. And then, not my timelines might not be as egregiously off as Elon Musk. The website is up. You probably could go to it and process a payment. But there's a few small things that need to be done. I would say, and my brother, I think, is still on the program. We've set up so many websites in our life. That last 20% is tough, particularly when you're taking payments. We're holding customer data. We're holding your username, your email. The credit card information is held at a third party offsite, but you're still, there's disclosures, there's legal stuff. I'm not trying to make excuses. I'm just explaining, unfortunately, the reality. If I were to give you a guess, it's probably next week. We tried to have it ready for tonight, but it just didn't happen. John, what are your top 3 holdings?
Currently, I am in full trader mode.
Okay.
I go into full trader mode in corrective periods, and I am completely opportunistic. So I do have several names. I've got a watch list right now of close to 15 names that are getting close.
What's a name on? What's a name?
What's a name? There is well, it's a continuation from the work that we did just last year on the AI names. So one of our best performing stocks that we wrote about was up about close to 280% from when we wrote about it. And that was a company called Credo. What Credo does is they make the cables that connect the equipment that's in a data center. So I am currently looking for the next generation Credo. It's not Credo. It's a different company. That company has a next generation technology that will allow data to transfer across optical cables in between the piece of equipment in an AI data center. It's kind of geeky technology that I'm not going to get into. Very, very early, but it fits the profile of a small company name, which is, and the company's called Poet Technologies, POET.
Here we go. Poet.
Oh,
wow.
So
okay. All right.
Poet is very early stage. I would put this in, if this is a baseball analogy, they're still waiting to come up to the plate. They have sent samples to 3 major potential customers, 3 big tech companies for their technology for their AI data centers. It's very early. If they do get adopted by at least one of these big tech companies, this $3.54 stock could be a to use a Peter Lynch, old portfolio manager, old mutual fund manager term, a multi-bagger.
Sure.
This has the potential to be to provide exponential upside because it's going to take some pretty novel technology to get the Blackwell chip that you've been alluding to for so many weeks when you talk about NVIDIA. That is a high-powered chip that moves data very fast and the current cables in between that connect the servers to the switches and the different pieces of equipment in an AI data center, they can't handle the speeds. It's almost like a traffic jam on a freeway if you're in a major city. And Jensen Huang, the CEO of NVIDIA, has referred to that phenomenon. So looking at companies that increase the pace at which data can move in a data center, companies that are more efficient, equipment that uses energy more efficiently, and also looking for companies that can provide energy efficiently to the data center, a company, or store the data. So I'm also looking at a company called Bloom Energy, BE.
What was that?
BE.
BG?
BE. Boy, Edward.
Bloom Energy. Okay. Wow, that one, like,
that's an energy storage company for both corporations and for utilities. That's kind of the biggest problem that will be holding back. So we're at the verge of not being able to get enough. These AI data centers suck up so much energy. There's just, in the current energy infrastructure in the country, there's not enough energy transmission to get them the power they need. So what these utilities are going to have to do is they're going to have to, when a lot of power just kind of dissipates, or if it's not used right away, they have nowhere to store it. So Bloom has a next generation technology for storing that energy before it's actually delivered to data centers. So it's kind of a tangential play on AI. So that would be a couple names. I will be posting. I'll be posting that watch list for potential subscribers probably over the next several weeks. Also.
Very nice. Okay. That is BE. That one like broke out. What I like is like it was in a very well-defined downtrend. Lower highs, lower lows, and then you're waiting for this breakout. On this breakout, you can retest to the top of the trend. You don't necessarily have to wait for that, but that's a beautiful spot. I love like that spot right there is buying it there, because then it's okay, stop loss just underneath that, because if you get back in that, it's probably making a new lower low. This is a fake out. I love that spot because it's like start of new uptrend is where that, like that's like the birth of an uptrend. I mean, you can go like, this is like, I don't know how small this company is. It's $5 billion company. You could go to like $1 trillion companies, and that's how the birth of a new uptrend is given. You're in the well-defined downtrend. Then you have the 2 green candle breakout. Then you have consolidation. Sometimes you walk all the way back down to a back test. That's a beautiful spot. Just beautiful. Beautiful.
And that'll be the best way. Exactly what you showed, Colin, exactly the way you showed that potentially playing out is like kind of scenario role playing, like what could potentially play. I think that's very helpful for a lot of listeners, because it's like, instead of, if you want to be patient, like have a strategy of where you enter, if it were to do this, or if it were to do maybe 2 other different scenarios. But it's also the ideal way to consider, if you do get access to that watch list, the ideal way to use it would be to run a scenario exactly like you just did.
Indeed. We've got a lot of we'll try to get to as many questions as we possibly can. We'll probably go on for just a little longer. We appreciate everybody tuning in. I mean, 750 people, John, watching us talk about Mr. Trump doing his throwing out hats. I mean, this guy is just, my God, this guy is just incredible. What was the question I had? Bullish on QXO. Yeah, still holding QXO. They just bought a roofing company, or they're like trying to merge into one. I'm bullish on home building in the era of robotics. So the other, we talked about like United States debt, Trump is dealing with it in his own way. Okay. I don't think he's doing himself no favors. What he did today for an hour, talking, throwing out hats, slapping his own butt. I don't think he did himself any favors. Okay. And I say that respectively to the president. Okay. Howard Lutnick is probably a better spokesman for that, but he's also cut out of the same cloth as Trump. He's, he can be a little loose with the tongue, but they're dealing with the debt, right? The other thing that we need dealt with here in the country is not necessarily that, but you need to be dealing with housing and housing affordability. Everybody, can attest to that, right? We need to deal with housing affordability. Part of it gets solved with robotics, automation, lower regulation, which I think Trump will deal with at some point. He's obviously a builder. He'll get to that at some point. I think it's probably like a summer, fall type thing that he'll deal with. Maybe he loosens up some regulations. Parts of California probably won't get loosened up, but maybe other parts of the country. So yes, I'm bullish. And I talked about it earlier. Home Depot, Lowe's. This is a trend that gets dealt with. Lower interest rates helps housing. Boomers getting older helps housing as well. Anytime you get a rotation of homes, doesn't matter if the price of homes goes up or down. In my opinion, it's somewhat like, yeah, when home prices are going up, it makes you feel good if you own one, but it doesn't really matter. If home prices were to collapse, that'd be great for Home Depot and Lowe's. Maybe not in the shorter term, but longer term. Now everybody buys a home and they've got more money to do upgrades. As it stands now, people are buying these $800,000 homes, and I don't know how they're doing it. Literally, like around the corner, one sold for $800,000. I'm like, what job do you have to buy an $800,000 home where I live? Like, I don't live next to Meta. You know what I mean? Like, I can understand, like next to Google. It's like, yeah, of course, the condo is probably $1 million, but where I live, I don't know who the hell's paying $800,000 for houses. But look, you get a drop in housing, frees more money up. If you get a drop in interest rates, and look, Trump could be absolutely tanking the markets with this, that would tank interest rates. You take interest rates, you get a refi boom like you've never seen. People are just waiting to refi. There'll be people refiing at a higher rate. They don't want to go from 3 to 8, but I'm not saying this is good financially. And John, you might disagree, but I think there's a long list of people in this country that would refi from 3 to 5. And pull 100K, 200K out of their house. That's a terrible idea financially. But I get emails all the time from like mortgages, and I get phone calls. Like my credit score went up and I get phone calls all the time. Like, pull money out of your house. Discover sends me something like literally every week and being like, your home's worth this. We'll give you this amount of money. Now it's at like 12% or whatever the interest rates are that they're doing that kind of like freebie money. But interest rates come down, there's going to be a lot of consumers that take advantage of that, where they're like, oh, I can click a button. And most people don't understand. Go from 3.5% on your mortgage to 5%. Most people just think, oh, that's no big deal. I mean, it is a big deal, obviously. But, I think that's kind of interesting that you get a lower interest rates, creates more demand for housing, creates more demands for companies like QXO. But QXO is it is a long way to go. Long way to go. So I've bought it. I've forgotten about it.
It's also run by a guy who built his the foundation of his last business was the global financial crisis.
Yes.
And that's where he was able to cobble together some great values to build the foundation for that business. And I think we both agree that he's one of the most savvy business operators in the country.
Mm-hmm.
Do you think that's still the case, Colin?
Yes. And I would just say, QXO should not be more than like 1% of your portfolio, in my opinion. But it's one of these things that you continue to hold. Fundamental story is still intact. It obviously will go up and down in these markets, but longer term, they've got a sound strategy. Rolling up the material business, the home building material business is very interesting. Home Depot is already doing that as well. If you look at like what Home Depot is doing, they bought like a roofing material company. So like if the big boys are doing it, at like the small end, it's probably attractive. Now you have more bidders in the market, but as interest rates come down, capital gets cheaper. As you have a lot of volatility, could create some opportunities just in general. My authorized dealer, I have very sad news as it relates to my authorized dealer. He no longer works. The guy I was dealing with no longer works at the boutique that I would go to. So I got a Sky Dweller. I got a Batman. I got a Submariner, the green one. Like, this dude was hooking it up. So he's no longer there. So that's disappointing. Now, he gave me the name of another guy, but I have not been able to go and hook it up. But if you want a Daytona, I would say find a boutique that sells jewelry and go in there with your wife, spend, 5-10 grand. And you're not going to get the best Daytona, but you'll get one. You'll get one. Is how I would say. But if you want to come to California, Northern California, I'll more than gladly take you into the Rolex dealer. And they love it when I come in. They still love it when I come in. But the guy I was dealing with, and then I had his phone number. I did favors for him. We'll just say that. He's no longer there. So that was very sad news, John. I was devastated when I found that out because, that's too bad. We talked about QXO. Continue to hold. ASML, hold it, baby. Hold it. Because look at that. You have that's a good 25-year uptrend, and you are there, right there, after confirming a new higher high. Now, it's ugly. I always say, hey, you're going to buy it when it gets down to here. And I always say this, when it gets to the bottom of the channel, it is never easy. It is never easy to buy at the bottom of the channel. There's always something going on. Maybe it's COVID. Maybe it's the great financial crisis. Maybe it's inflation. Maybe it's China, sanctions or whatever. It's never easy to buy at the bottom of the channel. That's why you make the decision in advance and you buy. And I have recently bought ASML because I'm a simple man, John. Stocks get to the bottom of the channel, I buy them.
Yep.
That's what I do. My man Drizzy, he says regarding the semiconductor tariff impact, how can they really enforce it with Singapore loophole? Does that factor in? That does factor in. I think semiconductors are slightly more complicated. I think semiconductors get negotiated over the next several weeks. And like you said, my understanding with semiconductors is they obviously the actual silicon is manufactured primarily in Taiwan. That chip is often shipped to China or Singapore or Malaysia or one of these other countries that is then repackaged into a server, and then it makes its way into the United States. Even the chips, here's the crazy thing, even the chips that Taiwan Semiconductor is making here in the United States for Apple, those chips go from Arizona, I'm assuming on a plane or they get on a boat or whatever, they go back to China, okay, to get put in a phone, or they go to India or whatever. So, I mean, that's why these tariffs are so crazy, because you could make the semiconductors in America, but the device would still be, subject to the 54 or 50% or whatever tariff that's coming out of China or Vietnam or Japan or India. So that's why somebody brought up a question earlier, is this just the opening negotiation? I think it's the opening negotiation, but when you listen to Howard Lutnick, this is an attempt to raise $1 trillion in revenue. So these are serious, and they're going to collect revenue, but many of these countries are going to have to come to the bargaining table. And many companies here in the United States are going to have to make massive adjustments on what they're doing. And the semiconductor business is probably the perfect example of that, because the semiconductor could be made here in America, but if you don't make the phone or the computer or the remote control or the Apple Watch or the earphones or whatever it is, that semiconductor goes on a plane back to China, Taiwan, wherever, and then I would assume it is subject to this. So it's just a nightmare. And I'm not surprised as we sit here today. When we came on, S&P futures were 3 or 4% down. Now you're 2.8%. NASDAQ was down closer to 5. Now it's closer to 3.5. Russell down 4%. primarily because what John says, most of these companies are actually not profitable. So when you're not profitable, and then you get a 20, 30, 40, 50% tariff slapped on, you have no room. Whereas if you're Apple, you can probably figure these things out. The supplier will eat 10%. Maybe China 54% is just unbelievable. Like, this will be, out of all of these tariffs, the one that I will follow very, very closely is obviously the China one. Does China just sit back and say, oh, we'll play the long game? Screw Trump. He's out of office in 3.5 years. We know this is probably unpopular for him, politically. Fuck it. We're just going to sit and screw, But again, China has to answer to its people. If you're the manufacturer sitting, and you're exporting a bunch of goods in the United States, and you're like, hey, China, the fuck? They got 54% tariff. Go call your buddy in Mar-a-Lago and get him to do something. So it's a push and pull. And that's what's so exciting. I would say that's so exciting over the next several, weeks, months ahead. What about Boeing? I love Boeing. Love Boeing. I love Home Depot, Lowe's, Boeing, these companies that no limited competition, high barrier of entry. Okay. Walmart would have already gotten, Walmart would have gotten into lumber if they could. They just can't do it. Boeing, yeah. Love this stock. Now, is there risk involved in Boeing? Of course. Would I have a large percentage of my portfolio in Boeing? No. But yeah, I love this. Look at the trend. Look at that trend. It is beautiful. It's been intact. Folks, this goes 1983. I was 1 year old. I was in diapers when this trend started. Here you are. Now it's gotten ugly more recently. You've had, pops and drops on this. A little bit of it has to do with COVID, but you got a clear area of support about where shares, slightly above where shares are. I like this one. Wouldn't want to see it get below 121. Currently you're at 168. Don't want to see it get below 121. But yeah, I like Boeing. Just manufacturing in the United States, one competitor. Globally, people have to buy their stuff. Air travel. Every time I fly on a plane, it's a nightmare. But yeah, so I love Boeing. Into that. AMD worth holding, yes. But in terms of semiconductors, if I were to rank them, NVIDIA, Broadcom, Taiwan Semi, ASML, then you get to AMD. How I would, and there's honestly an argument to be made for a Qualcomm even over AMD. Look at the trend in Qualcomm, and here you are. Robotics wise, Qualcomm, some exciting stuff coming, I think. Also, the China market, I think, the weakness in Apple handsets benefits Qualcomm. Another super sleeper semiconductor in robotics. I mean, this is way early. I wouldn't go out on Monday and buy this stuff. NXPI also has made some acquisitions recently, but also has a lot of IoT stuff. If you have a rapid acceleration in robotics, very interesting company here. Just understand with NXP, their automobile business is going to be in the absolute crapper, obviously, to relate it to what we're talking about today. I think there was a 25% tariff slapped on automobiles. So yeah, that is going to put a company like NXPI, which relies, I wonder what it's at in the after hours. This stock relies, I think 70 or 80% of their revenues. I'm surprised it's only down 3% in the after hours, but primarily because the automobile business is already in the shitter. And NXP has some stuff that I think is going to be transferred from automobiles into a robot is just a car. It's like a cell phone. You know what I mean? That's why with some actuators and a motor, right? Like a robot is not really that complicated. AI unlocks it. Okay. So you didn't really have anything like robots that did anything interesting until the software came to life. That's why I'm really excited about robotics, is because now the software is there. The hardware is there. It just needs to be instead of being put into a car or a cell phone, it needs to be put, you need to build these things from the ground up. NXP is in that space, Qualcomm also. And these stocks have not performed. Qualcomm maybe slight exception, but these stocks haven't performed that great. They didn't get the bid that NVIDIA got. AMD, again, is in that range of Qualcomm, NXP, AMD. they'd be in that range. But if you don't have any exposure to Broadcom, Nvidia, TSM, ASML, I would start there personally before I went to AMD. That's my opinion. Thoughts on CRM? Oh, how long do we have, John? I'm not right now. Technically, CRM is, you can nibble on it here. I probably like ServiceNow a little more. Maybe not technically, because that's ugly. But long term, that chart's still incredible. I tell you what, I am personally, may not be the right thing, but personally, I'm avoiding software because AI, like AI, it's incredible. Like you can literally just tell the AI to write you some code and it does it. Also, in a world where robots exist and AI cuts out jobs, like if you have a human resource component to your software, kind of like CRM, like if I have a bunch of robots and I have less staff because of AI, there's less seats for me to, like most software like Salesforce, and most of you guys know this is sold by what's called the seat. So per employee, I pay CRM, whatever it is, $30 a month. I don't know what it is, but I pay per seat. Well, in a world where I have AI doing more shit and I have robots doing stuff, what, are the seats growing or are they contracting? And so that's one fear that I have. I also have a little bit of a fear that it's far easier to develop software now. Like I can literally, not literally, but we're very, very close to where I can go to the AI and I can say, hey, Salesforce has this thing, make it for me, press enter, and it does it. That's scary as hell. I think, for a software maker. Now, CRM has great software. ServiceNow has great software. It's possible they benefit. The software that I'm excited about is the software that controls the robots. So you need, if you have like 800 robots doing something for your company, you're going to need relatively sophisticated software to control all those robots. Make sure they're in sync, make sure they're doing shit. Amazon is, just to give you like, an actionable thing on that, Amazon already has software that does that. And then it's part of AWS too. So you can, like, if you get a bunch of robots, the first company you're going to go to that already has off-the-shelf software for that is Amazon. The other one is NVIDIA. NVIDIA basically has software solutions that do the same thing. So I'm a little concerned about like mainline software. Like pure play software stuff. Little concerned. Jordan wants to know, do you hold any single stock 5-10% or more of your portfolio? Maybe not right this second, only because I basically had to like rebalance my whole stuff. But yeah, at times you will have a position grow into that. And that's just me. I'm kind of weird. I like to have some gold in the safe. I like to have some watches in the safe. I like to have some baseball cards in the safe. You add all that up. I don't know what the total value is. There's probably some equity in my house. All these things contribute to these types of things. But yeah, I'll let a stock run to, well north of 5-10% of my portfolio. At one time, NVIDIA had gone on, this was even before AI, NVIDIA had ran so hot that it was probably easily 10% of my portfolio at one time. It just what happens. Nike is probably a 5%, but it's only because I've held it for so long and it's just grown into that, even after the drop, because you've collected so many free shares with dividends that it's you hold these things for a long time, they'll grow into a large percentage. Thoughts on high bandwidth memory? I'm loving high bandwidth memory. I know the stocks have been getting killed. Micron 88. That hasn't been able to break out. Camtech got hammered. But it's coming into support. You hope. 50. It's probably good there. What's the other ones? KLA. I don't know if they're really high bandwidth memory, but yeah, I mean, all these stocks are going to get killed. They're just going to get hammered, and then these tariffs are definitely not going to benefit that. But no, high bandwidth memory is still a very much a trend. I think what we've actually seen is Blackwell has been much slower to roll out than anticipated. There was those initial problems late last year where there was like something wrong with it and they had to fix it. That delayed it way longer than I think than we realize. Any like month or two in delay, probably on the back end, delays the damn thing like 6 months. My research, and it's through two sources, and both of these sources are world-class sources. Like they get cited on CNBC and these types of places. You don't see volume shipments of these things, and volume where it's like really moving the needle until next year. So like you like maybe late this year. So it's just a matter. And so that obviously impacts high bandwidth memory. So if you don't have volume shipments of Blackwell, then you're not getting really like incremental more high bandwidth memory getting shipped. But overall, high bandwidth memory is still a great trend. You like to run these large language models, like memory is still like a thing. Hood. Oh man. Hood. I like the product. I've liked the product for a very long time. Used the product for a while. In fact, I just transferred a good chunk of money into Hood because they were offering such great incentives to do it. They were like giving you 2%. And if you got a decent account, 2% is some real money. So I've transferred some money into them, take advantage of that. I love their innovation. I love the interface. I love what they've done. Do I love the stock? Not really. I for whatever reason, these like fintechs, like the SoFis and the Hoods, I don't know. John, am I too simple of a man? I bring up Visa. You know what I mean? Look at that chart. Not a lot to worry about when you look at that chart. Yeah, there's some dips. I got a ton of lines on there, but I don't know. I'm a big cap guy. So Hood might just be out of my wheelhouse. I just think with these stocks, you've got to get them at the right price. My God. I mean, you were down here at 10 and it went to 60 and now we're back at 40. I don't know, but you are on this trend right here. This trend is like, for now it's intact. In the after hours, God only knows where it's going. The problem with Robinhood is you might get margin calls. I mean, you're down 10%. You can literally click a button on Robinhood and get margin, which is dangerous. I know buddies that like blew up I know like two guys that have blown up Robinhood accounts, where they deposit some money, then they're like, what's this margin thing? And I'm like, if you don't know what a ticker symbol is, you probably shouldn't trade on margin, but they'll like literally give it to these guys. And they're buying like Dogecoin and all this crap with it. So I'm worried a little bit about Robinhood in a down market because you get these margin calls and then, it's the financials will not look good at all. But at the right price, there's something here. This chart is like John, what would you describe this chart at? Is this like a happy face? Is this a U? What is this?
Yeah, that the way I describe it is still an uptrend.
Yeah, for sure. I mean that is fine right there. That is fine. But
and right at a pretty clearly defined support level. Like fundamentally, right. They are literally. I've never seen, and I can't tell you how many different brokers I've used for trading in the past. There is no, I don't currently use them, but there is no more dynamic broker than Robinhood in terms of product development.
Yeah.
They are leading edge. Yeah.
I love the product. I would have a stop on this one in the 30s is how I would do it. I don't think you want to get below. John, would you agree? Would you want to get below this level here, $33?
Yeah, you break even a little higher.
You break that,
the bottom of that little red candle there. Yeah, you break that, and then the next
right here
level is pretty kind of substantially lower. Yeah.
Yeah, I mean you're back into the 20s. Yep. So yeah, if you're taking a shot at Hood, I would do $10 to the downside. I mean, we're gonna open up tomorrow probably at 38. So yeah, I would maybe $5, $6 to the downside. And if you whiff, you know, you can buy in at a lower level. But I just, you know, if you do slip into recession and these tariffs stay into place and you get margin calls, you know, you're revisiting 10 on this one. Because I mean, you got a $37 billion valuation. I haven't looked at the financials of Hood in a little bit, but that seems, you know, I know they've got a lot of more money under management, but my guess is they're fractionally profitable. They were also allowing you to bet on the bet on the NCAA games, which I promptly made like $30 doing. I was sitting there watching the NCAA games and I was like, cool, I'm going to just bet on this on the app. I mean, it's not a bet, it's like a contract, but how that is legal, and they allowed me to do that on margin too. They gave me like $1,700 to like bet on the games. And I was like, my goodness, that could be great for them, or it could be absolutely terrible. They're just sitting in the middle of the transaction, very much like a sports book, but even more than the sports book, because there was no spread. So they're not at risk of one side tipping the scales more than, I think, the way I understand it. It's really just selling a contract, win or lose, and one person's on the lose end, one person's on the win end, and then they just sit in the middle and collect a spread. So it's probably not the worst business, but yeah, I love the product. For me, I'm like, I like other stuff. Netflix, I don't watch Netflix a lot, but I bought Netflix. Again, I'm a very simple man, John. Netflix got below the middle of the channel and I bought it. This will be shorter term for me. This will be shorter term. There's a stop on this one at like 8 something. So I'm playing 50 to the downside to make a new higher high. I don't think people will cancel their Netflix. It also is probably less impacted by tariffs. So, I mean, there's that. I also think the competition just is just missing the mark. You've got that Disney Snow White movie, which was just a brick. I like what they're doing in live sports. I just think the competition just is floundering. And then you have Netflix there that is like a shining star of the whole thing. So in a terrible sector, because I mean, God only knows, we bring up the chart of Disney. My God. I mean, 5 years, you're flat. 10 years, you're down. I mean, oh my God. I think my mother-in-law has Disney stock. She always asks me about it. And I'm like, I mean, just hold it, I guess. Because, you know, God only knows what you would buy if you sell it. But yeah, I mean, in a terrible sector, I like Netflix, I guess. Paid service, Mohammed, very soon. I know I keep saying that. Supposed to be tonight, but we're so close. You can literally go to the website and check out. So that is like 99% of it. Very close. I will say, Mohammed, should be done by the earnings season. We're rolling into earnings season. Like, when does Netflix report? They report in 20 days. Yeah, we'll be ready by then. And I'll post a ton of earning videos. I'll still post like Netflix, Nvidia, Tesla, like anything that moves really big too. Like if somebody reports, particularly like a Palantir or something, and I want to talk trash on it or something, I'll post that for free on YouTube, but I'm going to be posting a ton of stuff on the paid side. So like Chipotle, really interesting stock, really interesting spot. McDonald's, really interesting stock as well, particularly in this environment. Lowe's, Home Depot, Visa, MasterCard. There's just so much that the paid side's going to allow us to show, because like you can post I could post a Chipotle video on YouTube, but you literally, I mean, it's not about the money. It's just the value. Nobody watches those videos. You know what I mean? Like, this is why all your creators, all they talk about is Palantir, SoFi, Tesla, Nvidia. They only talk about the stuff, Super Micro. They only talk about the stuff that moves the needle, because they need views, they need money, they need clicks, they need subscribers and stuff like that. And so you don't see a lot of videos on McDonald's or Visa, MasterCard, these types of stocks. And this will allow us to do that and have really in-depth discussions where we don't have to worry about all that type of stuff. So thoughts on CoreWeave, John? My goodness. What's the ticker? Oh, there it is. CRWV. Oh, holy crap.
One word. Open AI. Actually, that's 2 words.
Yeah. So I think that contract came through. So we got to put this on an hourly daily chart just to get some candles on here. So this one bricked, not really bricked, but it kind of like faded
Yeah.
after the IPO. I mean, it's a brutal market to go IPO. And then like,
Yeah.
and this looks like it's like over several days. This was like in an hour. It went from like 40 to 60 on this one. Let's see where it's at in the after hours. CRWV.
I think it took a pretty good hit in the afterwards.
Yeah, you're gonna be down 10%. They're asking also how it relates to NBIZ or NBIZ. God, I can't pronounce anything right now. Nebulous. Yeah, that's gonna get hammered. Like this stock's gonna just. I mean, these things. Just understand with and this goes without saying, obviously, but these smaller names, we'll put that in air quotes. $5 billion company is still obviously large, but it's not Oracle. You know what I mean? Like these things, you're gonna have to stomach the. I mean, this thing was up 100%, and now it has retraced all the way back to where it was. You know, back in like December or whatever, November, December, when they kind of pivoted the company or whatever out of Russia. So now you're back at 20. So I don't think.
There's a good
No, go ahead.
question about. There's a good question related to CoreWeave because one of the reasons CoreWeave popped after that kind of weak IPO performance the day of and day after is they got two big customers, Microsoft and OpenAI. And OpenAI raised $40 billion. And with that $40 billion, they're going to buy a lot of CoreWeave services.
Yeah. Did you see this headline too? Google is closing on a deal to rent NVIDIA servers from CoreWeave.
Yeah. So they're just
too.
they're dialed in, and Nebius is in the exact same business. But they cater to more smaller size developers, AI developers, app developers, but Nebius is also trading at about, if they're going to do $1 billion worth of revenues this year, they're trading at less than a 50% discount on a price to sales. So, and that's not including the three other businesses that are worth could be several $1 billion. So Nebius is like a CoreWeave Junior at a 50% discount is the way I describe it.
Yeah, I like I mean, again, you're going to go through, you know, what's the analogy here? Like a G-rated one. You know, you're gonna have some ups and downs here. You're gonna have some ups and downs. Okay. It's like dating a supermodel, man. A lot of people are gonna be, you know, trying to pry her away from you. But if you hold the line, you know, you're gonna end up with a winner here. I just think the trend is so strong here. And as long as NVIDIA doesn't back out of this one, that would be the only thing that I mean, if NVIDIA backs out of Nebulous, it's cooked. So your whole thesis has to be NVIDIA holds their investment here. And that's tricky because you saw with like SoundHound AI or something, they like pulled out of that one and it got smoked. I mean, you just got hammered on this one. In fact, I think you went to 13 down under 10. So that's your risk again with these small cap stocks. Like it's a binary type thing. Like this thing's either going to like 10x or it's going to like crap out. And that's why it's tough. You know, that's why I tend to focus on, you know, it's like a lot easier to be like, you know what? Oracle is probably going to be pretty good. You know, $400 billion company, great founder. He's got ties with the Trump administration. He's got ties in everything, TikTok, all this stuff, 5-year, 10-year performance. It's just really consistent. You get a dividend. I mean, this is my type of stuff. But yeah, if you like the exciting stuff, yeah, the Nebulous, the CoreWeave on a pullback is probably interesting. I don't think at this valuation, I don't know, like IPO stuff, I'm just not, until you get enough price action on the chart, I'm just not, like, I don't know what to do with this chart. Like, this is just, you know, this is just some lines, you know, I don't know what this means.
And a lot of funds will wait several quarters for them to actually prove that their operating performance is there. So it's great. It's probably a good strategy to think. We both kind of think like, you know, the big fund, like what are the big funds doing? And some of them will buy the IPO. Most of them will wait and let them prove that they are going to post some attractive numbers.
Yes. More boomers are buying homes right now than millennials. That is true. But the one hope and saving grace for the millennials is those boomers will pass away and the millennials will end up with the real estate one way or another. The real estate gets put up for auction. The parents don't want to leave their kids any money. Fair enough. You get a influx of supply. My thesis is, particularly out here in California, is the very, very wealthy boomers that pass away, their kids are not going to be able to afford the property tax, let alone the value of the property. We're talking multi-million-dollar homes. So the value of those will probably suffer, but that median kind of home, and just knowing some boomers, my parents both thankfully still with us. They've bought real estate and they keep it. You know what I mean? They don't even rent it out. They just keep it. And so it's not, if you're a millennial, you're like, no. But that's what they do. That's what they do. And so, yeah, it is concerning, but I think you have a rotation there at some point. Also, you get further downtrend in this market and you get a downtrend in 401k values. The homes get put up for sale. The second home gets put up for sale. The longer this market goes down and stays down, that second and third home gets put up for sale because the boomer is like, oh shit, I had 4 million in my IRA. Now it's 2 million. Well, I'm going to go sell that cabin that I don't even go to, or, you know what I mean? Or I'm going to sell that second home in wherever. And that creates some supply. Super nuanced. I'm certainly not a real estate guy by any means, but enough discussion with the real estate people. And that's the broad belief of things. Now, every market is different. Okay. I can only speak to California. California's market is completely screwed up. But depending on where you live, all these things, there's nuances to all these types of things. And so I can only really speak to what I see out here in California. Obviously, if you live in Oklahoma or Texas or Florida, all the markets are different. But broadly speaking, out here in California, yeah, wealthy boomers have like 3 homes and like nobody's in them half the time. That changes. One, when they pass away, because the kids aren't going to own the 3 homes. They're not going to be able to afford the property tax on one of them, let alone 3 of them. And that creates some opportunity. John's Twitter account, X account, I guess is what I should say, is Satori Trade. SATO. I'll actually put it in the chat. Satori Trade. Give him a follow. Did I say that right?
Story trade. Yeah, it's the Japanese word for seeker of truth. Some version of that.
There it is. Financials. BAC, JPM. Yes. So we didn't get into it a whole lot, but the plan by the Trump administration, just to recap, those of you that have been from out, John, we're 2 hours and 40 minutes in and we got 840 people tuning in. So we shout out to everybody in the chat. We really appreciate it.
Love the group. Great questions. Really appreciate it.
Yeah, we appreciate you guys supporting us. It's just, we really, really do. Thank you so much. The plan by the Trump administration is to balance the budget. They do that 2 ways. Number one, Elon Musk taking a hacksaw or a chainsaw to the government. He's going to save $1 trillion. What I am telling you is not speculation. This is literally from the horse's mouth, not the horse's mouth. Donald Trump is not the guy to listen to. Donald Trump is, with all due respect to the man, and I have a lot of respect for what he's accomplished in his life. Okay. Anybody that can become president, I have huge respect for, whether you're Joe Biden or Donald Trump. He is not the guy to listen to. Okay. The horse's mouth is Howard Lutnick. And what's the other guy? Scott Bessent.
Okay. Yeah.
2 Democrats, actually, in his cabinet. Both. Now, I don't know how they vote more recently, but these are like Democrats. And Scott Bessent is actually, he's married to a man. So, the diversity in the Trump cabinet is, it's there. Nobody really talks about it, but it's there. That's not here nor there. But the plan is for Elon Musk to take a chainsaw to the government and to save $1 trillion. Howard Lutnick's job is to raise $1 trillion. And they have to do this. They don't have to, but the plan is to do this without Congress passing a bill. So the way you do that is you do exactly what they did. You do the tariffs, because you can slap these on with some kind of national emergency thing, which Trump did. You slap these on and you start collecting revenues. Whether you collect $1 trillion, I don't know. Now I'm looping back into the question. The question is financials. Well, the plan is to remove the federal government from being kind of the lender to the banking system. And the other thing that they talked about, I don't think I have a clip up here. Scott Bessent and Howard Lutnick talked about this. I don't see anybody talking about this. They're going to lower the regulations on the banks. Now, I am not a bank regulation expert, but there's like Basel 1, Basel 2, Basel 5000. Okay. There's all these regulations on the types of assets that they need to hold, how much money they need to hold in reserve, how much needs to be bonds, and the rules constantly change. And then they have these stress tests, which, like, if you listen to Jamie Dimon talk about these things, it's like he I don't even know if he understands it. Okay, with all due respect to Mr. Dimon, he barely understands these things. Okay, now who this hurts the most is not necessarily the JP Morgan. Now, like, I own 2 individual bank stocks, and JPM is one, and you can see why. Because I'm a very simple man, John, as I've been saying, and that chart right there is absolutely fantastic. You buy it at the bottom of the channel, and you can sell at the top if you want, but I haven't. Continue to hold JPM. The other one is Bank of America. Slightly worse situation, but I remember doing videos when this one is at $27, $28. We've rallied up into the 40s on this one. So you've had pretty good short-term return. This was like a blue chip buy alert back in 23. So you've done okay on that one. Slightly different balance sheet. If you do break to the highs, they're up here at 55. You could have a breakout. Long story short, these banks are going to allow to, instead of the government spending so much money, it's the banks going to be lending to private institutions. Okay. And who this probably benefits the most are the regional banks. Is it XRT? No, that's retail. I can't remember the ticker on the, do you know the regional bank ticker?
XLB, maybe?
KRE, that's right. Who
yeah.
this benefits the most is the regulations being lightened probably benefit the regional banks the most, because they are the ones, they're subject, like if you're like Farmers and Merchant Bank, you're subject to like the same regulations and standards, not dollar for dollar, but subject to the same standards as like JPM, which is insane. Okay. And some of that had to do with the fact that you had that Silicon Valley bank that went belly up out here in Silicon Valley. And then I think there was another one. There was First Republic, I think it was, and that got sold off to JPM. And so you will have some failures in the regional banking market. That's why I wouldn't necessarily go in there and try to pick winners and losers. But if you're looking to add financials, look, I'm never going to tell anybody don't invest in the majors. Wells Fargo has some like asset caps that get lifted in a deregulated, but the stock has run in advance of that. As you can see, like, holy crap, Wells Fargo broke to new highs in advance of that, like, regulation being pulled off. And this dates back to when they had that customer account crisis where you went from like 40 on the stock down to 20. So the government put regulations and caps on how much assets that they can have under management. So that's obviously limited the amount of revenue that they can generate. That is being lifted, in the process of being lifted. So you've had a run of this. I would say another stock out of the financial sector that's similar is Boeing. Once the caps get lifted on how many 777s they can deliver, then this thing runs. Very similar to Wells Fargo. They're just earlier in that process. Wells Fargo is like, you know, if you had like lesser regulations, they'd already be lifted. But that's coming. Long-winded way I'm saying that's coming. And I like the regionals. If you already have exposure to the majors, I probably like the regionals. I wouldn't try to pick winners and losers in here unless you're like a regional bank expert, which I certainly am not. But KRE gives you a nice little basket of the regionals. And then look, some of them will go belly up. Some of them will make bad loans or do stupid stuff. Risk management is like a thing. And so that's why I wouldn't try to pick winners or losers. Because if you had, Silicon Valley Bank, you would have, you got crushed. So I like the regionals. In a deregulated environment, I like the regionals. DFS. And is he talking about daily fantasy? When I see DFS, Discover.
Discovery.
I don't know much about. And Capital One. I don't know much about this. That's what I would say, Jordan. I don't know enough about these stocks. Capital One looks like it's just like broke to a new high, so that looks fantastic. And then I always think daily fantasy sports. Yeah, I mean that chart looks fantastic. I mean, it looks a little like JPM. It's like a little, it's like setting up at the top, but yeah, financials. If you want financials, there's the XLF. I don't know how much like Capital One and Discover sitting there. XLF is, it's extended, but financials under Trump in a deregulated environment, balanced budget. If all that stuff plays out, it's fantastic. MasterCard, Visa, Amex. I don't mind. I don't mind. I don't mind concentrating into a sector, but focusing on like the big guys. Amex chart not as pretty as the other ones. But like in semiconductors, like I don't mind Nvidia, Broadcom, TSM, ASML, semis rally, you're gonna fucking crush. I mean, if they don't, then yeah, you're gonna get smoked. But I don't mind kind of concentrating. Starbucks, I love. This is a pure fundamental thing. Technically, it's not bad. I liked it more lower, and we recommended it back in December, I think, at like 90. And it went from 90 to 115. I mean, it's back to like almost 90. I like it because you have Brian Niccol as the CEO over there, and Brian Niccol ran Chipotle. And if you want to look at what Chipotle did under Brian Niccol, it like 10x'd. So, and his strategy with Starbucks, and I'm saying this as somebody that I don't drink coffee. I don't drink coffee. I don't consume Starbucks product, but I've been in there enough to understand their problems, and Brian Niccol's strategy is spot on. If you go to our newsletter, which if you go to like colintedders.com or Investor Channel Substack, there's a lot of redirects to this. I've written up on Starbucks. I wouldn't say extensively here, but there's several articles as it relates to Starbucks over here. In fact, the last one was back in late January. So Boeing and Starbucks, kind of my beaten down place. Nike's there too. They just haven't gotten there yet. Am I buying after the drops today? I'm in buying mode. Yes, I'm in buying mode. I'm in buying mode because I believe in the plan to balance the budget. I actually think it'll work. There'll be a lot of short-term pain, but if you balance the budget, then everybody wakes up and be like, wow, that's great. The tariffs suck, but my God, we've got to deal with this. And if you start dealing with this, it gives me a lot more confidence. I mean, there's a reason why I have like gold, baseball cards, Rolexes, jewelry. It's because of this right here. It's because of this. Because like if all goes to shit, your stock account, they won't even let you trade your stock account. Like just understand, if the world goes to shit, you don't even get to log into your account. Like they'll stop trading. People always ask me like, oh, what happens if China invades Taiwan? Well, the stock market probably doesn't trade. So it's like, what are you going to do then? You know what I mean? Like the Rolex in the safe is still worth something in that environment, right? I know like the world going to hell, like nobody needs a watch, but it's worth something. It's probably worth more than the paper. Okay. If I have a bunch of cash, paper, money sitting in there, it's probably worth more than that. Okay. If the electricity grid goes down and we get attacked or bombed, I'm talking to like doomsday shit here. Okay. If we get attacked or bombed, your crypto, there's no way to access it. Zero way to access your crypto. Your paper money is worthless. Your stocks you won't even be able to log in and trade. The markets won't even be open. They won't let you trade. There'll be no liquidity there. And then when the liquidity gets opened up, there'll be such panic selling that it'd just be insane. And we've seen some of this. 9/11. I mean, my God, that just incredibly tragic shit. Okay. COVID, same thing. Okay. So this shit can happen.
I've been through it. Crash in 1987. Broker,
you've seen it.
Down 23% one day. Brokers were answering the phone. If you wanted to get out, you could get out. They'd bid like 50% lower. Yeah, great.
Yes.
And now they just won't. Now they just won't even give you access to your online account.
Right.
Yep.
They won't even get, I mean, we've seen it with even like the GameStops and stuff. Like when you start manipulating this shit
Yep.
enough, they don't even let you log in.
Yep.
I don't
Yep.
know how I landed on that, Barry, and buying the dips. Yes, I'm buying the drops because I believe in the plan here. Do believe in the plan. Now, I don't necessarily all agree about the execution. And that's what like Bloomberg and CNBC and the MSNBC and the Fox News, they're arguing about the execution. I am comfortable with Trump being a poor communicator on this subject. He got up in here and he did not explain what they are doing. They're trying to balance the budget, which if they do is absolutely unbelievable. And I would say unbelievable in a good way. I would say that if this was AOC and Bernie Sanders doing it, or Biden and Harris doing it, or Harris and Waltz doing it, I would give them props. Okay. And so I'm trying to give props where props is due. If you deal with the debt, and the way they're dealing with debt is Doge with a chainsaw and tariffs. And they're doing it without the act of Congress, which again, everybody has their own opinion on. But my Schwab account doesn't care about anybody's political opinion. All it cares about is if this gets dealt with. If this gets dealt with, long story short, is fuck, your stocks will be worth way more if they actually deal with that, for sure. Double top hood. Yeah, Ben, that's possible. He's saying this is double top. Yeah, I mean, yeah, that could be. Yeah, you double topped on hood. It's not good. Not good. I would say, yeah, support on hood is like 32. You break 32 and God only knows. I'm a little worried about the margin calls there. The longer the market stays crappy, like have fun with that one. Any reason you don't see a channel using dual cash flow model to determine? I think that's what he means by DCF. Dual cash flow model is okay, but I don't think it beats price. You know what I mean? Like, is dual cash flow model better way to judge Apple, or is just the price of Apple a better way to judge it? I'm just a simple guy. Okay. Now I went to business school. I was probably tested on dual cash flow model. I think that's what he's talking about here.
Discount cash flow model.
Discount cash flow model. I've set up Excel sheets that like calculate it. I'm just more of a simple guy. I'm I'm a price guy. You know what I mean? Like there's a lot of ways to value what a house is worth. I think comps and location are probably, how I would value it. And interest rates probably, or payment. So I just like price. And then like all other like price to sales, price to earnings. Like if you were layer on price to earnings, price to sales on the Apple price chart, it's going to be about the same. So I just look at price. I'm just a really simple guy. Now it's a little more nuanced. If we were to open up the financials, maybe I am kind of doing a discounted cash flow model when I open up the financials. But when it comes to just determining when to buy and sell, I don't really like using anything other than price. I don't know.
The hard part with DCF is both the CF and the D. Like forecasting the cash flow in the first place, like going out within a couple of years is virtually impossible with most tech companies. Tough. And then the discount rate you get to use. Like,
that's a great point. So the stock that a lot of people bring up from a discounted cash flow model is Uber. And then, if you're looking at Uber from a discounted cash flow model, it is unbelievable. Like this is a great stock to buy from that metric, right? But what it doesn't factor in is what if that gets screwed up, right? So like an Uber in particular, what if they have to buy a bunch of EVs and AVs and, what if they have to, build out the car washes and the vacuums and all this other shit? You know what I mean? Like what if they can't sit in just the middle of a transaction and they actually have to invest CapEx to run their business? Well, then your cash flow model gets fucked. You know what I mean? So if you're valuing it on that, you get screwed. Same thing with Apple. Okay. Apple is their cash flow model is based on, manufacturing stuff in China, and a 54% tariff put on place for any length of time, all of a sudden screws up their cash flow a lot. Okay. And so that's the nuance to that is what I would say. the importance and impact of the next upcoming April earnings season could be there's a lot writing on it, I would say, on these earnings seasons. Here's and I don't know if this is the answer to the question directly, but you're going to have a lot of companies use this right here as an excuse. If your favorite stock, the CEO gets on there and he starts blaming this shit right here, that CEO is a fucking loser, and it's probably a loser stock. The best CEOs are going to be like, okay, we're dealing with it. We're doing this. We're doing that. Maybe it's a short-term headwind, blah, blah, blah. The loser CEOs will just be like, well, we had tariffs. It's like the ones that are like, well, there was a hurricane. It's like, yeah, there's a fucking hurricane every year. You know what I mean? Like, we get it. Those are like the loser CEOs that I try to avoid. Like, once they start doing that and they're like, oh, yeah, we got tariffs, so, it's going to impact us, and we don't really have anything else to say. It's like, do something, bro. Like, you're the CEO. Do something. Okay? So I would say that's the thing that I'm looking for a lot in the next earnings season, particularly on the fringe companies. Do they sit back and are like, yeah, AI is disrupting our business? Yeah, tariffs are fucking us. I mean, if they say that, it's like, okay, yeah, of course. Now, what are you going to do? It's the CEOs that have solutions that say, okay, we have tariffs. Cool. We have 54% in China. We've shifted some to Vietnam, who's working with the administration. So, by Q2, Q3, Q4, it should be this, that, and the other. Or we're moving it back to the United States. And here's how we're going to do that. And yeah, it's going to screw up our CapEx because we got to build a factory. We're going to go buy one. Those are the CEOs that I'll stand up and applaud. But there's going to be a lot this earnings season that are going to be like, yeah, we got tariffs. It sucks, and those are the losers that you definitely want to avoid.
And any company is blindsided by a recession or a slowing in the economy is also in that same category, because it's like probably coming. There's probably going to be a lot of downgrades of earnings estimates over the next couple quarters. So something to consider on the dip buys. Indeed.
And that, I mean, I've called for a lot of CEOs to get fired, so I'm certainly no sympathy at all for them. Based on the charts, technical analysis, the probability time frame for the SPY to reach an all-time high if things turn around. So, I mean, we're not far from the highs on SPY. I mean, let me slap my little thing on here. We're 7% off the highs. So we're not even, this is not even, I mean, if you zoom this chart out, John, can you see the downtrend that we're in right now on this?
No. Fairly noticeable. Yeah. Doesn't look like a reason to be freaking out right now. Yeah.
Right. So do you remember the one from 2000 to 03? I'm assuming you probably remember that one.
I remember I was running my hedge fund in 2000.
You were running your hedge fund during
that vividly, and I do remember 2003 being one of the best years I've ever had trading. So yeah,
there you go. Yeah, in these downtrends can be really, really exciting. 07 to 09, that's a downtrend. My God, I remember that one. That one was rough. And then the COVID one, you blinked and it was over. So we'll see how this one deep pulls back. If it pulls back to trend, I think you've got another, I think you're only halfway done. So you're down 7. You probably got another 7 or 8 to go. Just to get back to trend. That's just to get back to trend, which I have identified by this purple line. And it's not like, it's not drawn on there like with high precision, but that's more or less the trend. And so this one could get back to about 16% drawdown from the highs, which again is another 7 or 10% lower than where we're at now. And, I wouldn't be concerned. That'd be like I wouldn't say a back the truck up moment, but I'd be buying that dip. That's for sure.
It's interesting that like the CNN fear and greed meter is like pinned in the red zone of like fear, and we're down 7%. I mean, I've never seen that kind of negative sentiment down 7%, especially after a 70% move.
That's a great point. And what I think about the way I think about that, John, is a couple of reasons. So you're talking about this fear and greed index. And this is like, this comes from like CNN, and then you have extreme fear. So the way I would explain this is probably somewhat politically. You had a shift in this country where you had during the Biden administration, like Trump supporters and conservatives were super bearish. Like everything Biden did, whatever, they were pretty bearish. Okay. Whether or not they reflected that in their positioning, but they were bearish. So that group is completely flipped, right? Not necessarily 180 degrees, but most of them have flipped. And they're happy about Trump and whatever. Maybe he's doing some stuff in the short term, but in general, they're probably okay. Okay. Then you had the Democrats who were pretty rosy under Biden for a number of, I mean, from a stock market perspective, things were fine. Okay. Inflation, border, all those other things, you know, we can argue that, but we're not here to do that. All those people have flipped. So you literally had half of society, they flipped. And so I think that can, and again, this is not a I don't think this is like quantitative unless this is this based on.
Yeah, they've got like the indicators below there.
Is this survey data or is this?
No, there's several different
so this
indicators.
Is quantitative.
Yeah, it's quantitative. Yeah.
So that's interesting. I think though some of it is political. I think that you had, like, I can just speak from experience, having, you know, growing up in California, you know, having, you know, relatively, you know, liberal family members. You know, I know a lot of them that were very bullish during Biden. And then when Trump got elected, they got out. You know what I mean? And I'm not saying that's a good thing or a bad thing. I'm just saying that that's people's perspective on these things. And when Trump starts doing what he did today, I don't think he did himself, obviously, any favors today, as we're, again, kind of highlighting the after-hour move. Tell you what, John, I'm not trying to make predictions here on a one-day move. It doesn't really matter in the grand scheme of things, but it would surprise me if we're green tomorrow. I mean, you're down 2.7% futures in the after hours. The NASDAQ has gone from 5 down to 3.3% down. The Russell's probably going to be in the shitter just because, again, those companies cannot survive. Those companies don't have profit margins of 10%. Now you're layering on tariffs that are 10% or higher. Those companies get fucked. So I understand like why Russell is, you know, it hasn't really bounced back, but yeah, I mean, the fear and greed, your point, John, was like, we're 7% off the highs and the fear and greed index
barely
is
noticeable, like you said, on that long-term chart.
Yeah. So that's why I'm not concerned. Not concerned at the moment. Not concerned at the moment. Fundamentally, things can continue to break down. And obviously, you know, we'll dissect those things when we happen. But you got $36 trillion in debt. You got to deal with it one way or another. And the Trump administration is dealing with it in the way they want to deal with it without the act of Congress. Assuming you got 20K, how should I allocate for the next year? You know, I would just, whatever you were doing in the past, okay? If it's an automatic deposit, just bump up your deposits. You know, if it's an automatic, like if you get a 5%, you know, you get a paycheck every Friday or whatever it is. If you're doing 5% of your salary pre-tax or post-tax or whatever it is, do 6%, 7%, or how much you can afford. If you've been dripping it in a little bit, I would just increase the amounts at this level. That's all I would do. Now, I would, if I had 20K to invest right now, I wouldn't put all 20 in because Trump doesn't care. Trump doesn't care, which is a shift from his first term. And we also know that there's going to be a lot of negotiation, a lot of uncertainty, a lot of stuff that has to happen with these tariffs. I mean, this is just, you know, you got a lot here to deal with. So everything is down. Thoughts on NU trade desk? Ooh, the trade desk. I know a lot of people talk about the trade desk as an advertiser. John, what do you think about that red candle there? You can definitely see that one. You zoom out. My God.
That uptrend has been
the uptrend is over.
Reversal. Yeah. Wrecked.
Yeah, that's ugly. You are pulling into an area. I mean, there's an area here at 40. You would not want to get trade desk below 40. Get below 40, I don't know where it's going. I don't like the advertising business right now, except for Meta. And I'm just speaking purely fundamental as an online advertiser that has spent money on I spend money every day on Google. I like Meta just because disruption. Trade Desk, the top of in a recession, top of funnel goes away too. You have the top, the bottom of the funnel, which is Meta, that goes away. The small business is, not to use like industry terms, but like the Trade Desk caters to more of the Pepsis, the Procter and Gambles, the programmatic. It's called programmatic advertising, where it's like a bazooka where you're just spraying the advertising. Also, it potentially in this drop too, I don't know the Trade Desk well enough. It could be that they have pharmaceutical clients as well. And I know that Robert Kennedy is trying to ban advertisements of pharmaceuticals. And so if any of their advertising is coming from that, and I know like sometimes I watch TV and it's like, yeah, like freaking Ozempic ads or, any of these medicines or whatever, they're getting advertised a lot. And so if you're exposed to that, you're screwed. Like you're screwed. I don't know if they can pull that off. I don't know the legalities around that. I don't know if that'll actually happen. I just know that idea is being floated. So I wouldn't want, like, that's further risk to the downside. If those, like, those got to be like huge top of funnel advertisers, like Ozempic and Wegovy and Eli Lilly and these companies, those got to be massive top of funnel advertisers. So I wouldn't really want to be exposed to that.
And they might be exposed to a teenager that creates an AI program that disrupts their programmatic platform.
It's possible, yeah. Possible, yeah. And I just think in a world of AI where we're searching different, we're not clicking on ads a lot, you're not visiting websites as much, where the Trade Desk is going to, a lot of their inventory is going to serve on websites, right? Totally. The CNNs, the Yahoos, these types of websites. Like, are we clicking on those websites as much? Like, I don't have I literally for the past 15 years, that's how I've made money. Set up website, buy ad, have traffic come over, and the traffic does something. They buy something, they do an affiliate click, they click on a Google ad, whatever. That's been a great business for 15 years. It sucks right now. Like, that business sucks right now. And most of my websites cater to like 50-year-olds, 60-year-olds, people that aren't using ChatGPT. I can only imagine if you had like a website that catered to like 20-somethings and 30-somethings, they've all gone to TikTok. A ton of search traffic flows through TikTok now. Product searches obviously go through Amazon. They have their own ad business. I'm not trying to completely shit on the Trade Desk. I don't know their business well enough. I just know that, like, my God, the business sucks, and I don't know if it, I don't know if it turns into Blockbuster or this is just a temporary thing, like I just don't. And I speak from some experience here where I've spent, I think I looked at it the other day, past 10 years, I've spent like $400,000 on online ads. So I've spent my fair share of money on ads. I know the business a little bit. It sucks right now because of AI. Now it's great because of AI, because there's other ways to make money, but it does suck. Peter, we appreciate you guys. I mean, John, Can you believe it? We're 3 hours in. I think my brother probably had a Tinder date. He had to bounce. We're 3 hours in. We almost 1,000 people tuning in. Can't believe it. Thank you so much, guys. We'll do these lives again. We'll come up with we'll come up with something else. We really appreciate the support. Yes, the people want to pay for the service, take my money. That's what I keep telling the website guy. We appreciate that as well. And look, when the service launches, if you can't afford it, if it's too much or you're not ready for it, don't worry. I'm the worst salesman, John. So I should not be pitching these types of things. But and I was terrible at this at market wise. If you can't afford it, if it's too much, don't worry. There's going to be a lot of free content. We're also going to have other price points later on. Okay. So don't worry. But if you can, we obviously really appreciate it. Thank you so much. SBNY. What the hell is that? SBNY. Oh, Signature Bank.
A couple of regionals.
Yeah, these regionals, you're on your own. Look at that chart. I don't even know what that chart is. I mean, that's, oh my God. I don't know. Yeah, the regionals, you're on your own. I would ETF the regionals. I'd reach you. Yeah. Capital One is is acquiring Discover. My God. Capital One. Yeah, that's crazy. Cap One. I don't know the ticker. But yeah, that's consolidation in the payment industry. It's interesting. It's probably interesting for maybe not PayPal. That's back test as a trend. There's a trade setup. I don't know what you think about that, John, but like I feel like here's what I think about PayPal. And you can tell me if I'm wrong about that. That was the downtrend. Obviously, the downtrend was way steeper, but you had a continuation of the downtrend, but then you had a break. Look at this. This is like textbook stuff right here. You had a break of trend, but then back test to trend, and then you had a rocket from there, from like 58 to 92. And now you're back to, if this is the new trend, it's not really great because the highs were so high, but I think you're like moving into that. I think that could be a buy there. That's how I see it. I don't know if that's, but you know, you have your previous lows here, 58. You don't want to get below 58. You probably don't even want to approach 58. But if PayPal's a trade, you know, it's a buy here, stop loss 58.60. I guess I should see where it's at in the after hours because God only knows. You're at 63 in the after hours. So, you know, you're right here. I mean, you're literally right on that. So that's one if you want to trade that one. That's the setup. I see like a rounding, you know, beginning of an uptrend. Fundamentally, I hate PayPal, but trade wise, it's interesting. I mean, it's growing at like 1%. It's just not exciting.
That's not going to get on either of our radars. Yeah.
Yeah. Fundamentally, it's not great. JPM. Didn't they put them on a stop of another financial? JPM, I mean, the stress test, what I would do is I would reference you to Jamie Dimon. Whenever Jamie Dimon goes off about regulations and stress tests, he's a colorful guy, and that's how I would do it. Bros is a better long-term play than Starbucks. I would probably agree with that. You're just gonna have some stomach aches with Bros. You don't have a dividend, you don't have a buyback, those types of things. So I'm a dividend large cap buyback guy. But I actually teach a class to 7th graders, and two of the gals did a presentation on Bros, and like they were up there for like 30 minutes. I was asking them all kinds of questions about it. They knew more about it than I did. But this one also looks like this is the hood chart. So you IPO double topped, and then it's like the U shape. Like I'll bring up hood. It's literally the exact same chart. So
but they're twice the size that they were at the last top. So
yeah. I like I'm not a customer of Dutch Bros, but I like it at the right price.
Yeah.
So, but I wouldn't look at it. I would say just broadly too, Ben, I wouldn't look at things like, you know, Republican versus Democrat, Lakers versus Celtics. You know, and I think we have a tendency to do that just as human beings. I think it's Starbucks and Dutch Brothers. You know what I mean? Like it's McDonald's and Chipotle. It's not McDonald's versus Chipotle. It's both. You know what I mean? Like it's both. Now, I think there is some, you know, there is some of that, but, you know, a great example is like Google and Meta. Like they both do the exact, I mean, I would say the exact same thing, but they're in the same, like most of their revenue comes from the exact same thing. And both stocks are, you know, Meta had that big drop, but, you know, they both look about the same. So, you know, you can do both is what I would say. But I would say, yeah, if you're looking for growth, Dutch Brothers for sure. If you're looking for like stability, turnaround, valuation, probably that.
Yeah, and Ben, we're going to be covering both kind of strategies too. We'll be covering the big caps that are growing a little bit slower, but more dependable, less risky. Aren't gonna blow up anytime soon. And then a little more aggressive on the small cap side. So yeah, we'll cover both angles.
I don't want to be talking my own book here, but yeah, Microsoft, CMG, yeah, those are buys. 6 insiders bought shares. I don't know what stock you're talking about there, Michael, but when insiders buy, it's a good thing. I know that LVMH, I think you have to do the F. Yeah, you want to see insider buys, go see the insider of Louis Vuitton. Yeah, he's buying this. He's buying this like women are buying the handbags. Chart doesn't look great, but you're on support here. Is what insider buys is a good thing when they're in there. No alpha on S-Bucks. It's possible. It's possible. It's possible. Coffee beans and tariffs, probably terrible. probably really bad. Where does coffee? They come from Colombia, right? So tariffs on Colombia, and you're at 49%. so it's probably not good in the short term, but it creates opportunities, and you deal with it. He says there's no way you were a trader in 1987.
That was my first year, Ben. Yeah.
Wow. Yeah. I mean, there's some doubt if they're going to balance the budget. It's. I don't know. That's the mystery. But if they come close, I don't think they're going to balance the budget to the dollar. But we're currently sitting at a $2 trillion deficit. So if you can get a little closer to balance, I think that's probably good. Major headlines that would cause the downtrend to reverse. Two headlines, couple headlines. Peace with Russia and Ukraine would help. Lesser tensions in the Middle East. That's obviously, both of those things are probably slightly reduced. To me, it would be China and the United States coming together. If Xi, now I don't anticipate this happening, but if Xi was like, Mr. Trump, we're going to lower all our tariffs, and in exchange, we would like for you to drop your tariffs and for NVIDIA to be able to sell us any semiconductors that they want. If you do that, my God, I mean, it's straight up in the air, in my opinion. If you don't do that, that would be the headline. That would be like a straight V-shaped recovery. Would be China and the United States basically having a kumbaya moment. Is how I would describe it. Michael says he's 68 and he's seen many bubbles, and this summer could see the worst dip. Yeah, it could. I mean, you're kind of, you're walking into it. I don't know. If I was 68, I'd be very concerned. If I was 68, I'd be giving a lot different advice here. And that's what's going to be great, John, is we're both going to be doing this, and we're going to be like getting grayer and grayer and older. And we'll be on here in like 20 years, and we'll be like, we're just buying gold and we're buying whatever. You know what I mean? like
T-bills, 100% T-bills.
We'll be like Buffett. And we're like,
yeah, we'll be like, just like Buffett. Yeah.
Because I think if Buffett was like 40, he'd be like moving and shaking right now.
He'd be running a hedge fund and be like, total cowboy mode.
Yeah. But I think the age and where he's at in his life and all that other stuff.
90 something. That's why he's sitting on cash. Like,
right. So like, I would just say, just keep that in mind when you're listening to us. This is not, we're definitely not trying to give portfolio management advice to the retired and to the person that is, close to retirement. You cannot play Trump's game if you're close to retirement. You just can't. And then in 3 years, my goodness, it is going to be a wide open. God only knows who's going to run on either side in the platform and what's going to be at stake and all those types of things. Like, I don't even want to hold into that, So yeah, if I was like an older guy or older girl, I'd be, gold Rolex watches and I don't know. Maybe Berkshire Hathaway. I don't know if I were to be in a single stock. So I'd be sidestepping all of this. So, and I would not blame anybody for doing that. Would not blame anybody for doing that.
And it's good to have a range of scenarios too. Like, most people can't, they think, oh, it can't get any worse than this. Well, anyone who's been through a couple of recessions or bear markets, the market can get a lot worse than you feel at any given moment.
That's true. Yeah.
Pendulum swings more farther in both directions than most people expect.
Yeah. More. I don't even know if I want to get into Uber. Like I mean, we would be on here for another 3 hours if I started going down that. Alex with the $5. Thank you, man. Appreciate the content. Appreciate the super chat. $5. We appreciate it, my man. Really, 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 really appreciate
Thanks,
it.
Alex. That's awesome.
Yeah, Bloomberg. I watch a lot of Bloomberg TV actually. I watch, so I hear the, there's at 9 a.m. my time, there's a very relatively liberal political show, and I tune in. I actually tune into that. And I appreciate it. It's not offensively liberal. It is listen. The other one I want to recommend is, if you guys are just kind of want like stuff to watch politically, is, and not that you need like my opinion on this, but there's two-way, and this is Mark Halperin. He is pretty well known. He got his start politically, I think, in the Clinton administration, and he's been on every network. Sean Spicer is on this, which most people probably recognize. And then the other guy's name is Dan. I'm not exactly sure his last name, but you basically have Mark, who's kind of like I would say he's like right of center politically, probably, at least the way he comes across, but he's relatively neutral. Sean Spicer is obviously like pure MAGA Republican. And then Dan is like, I would say like moderate, not super far left Democrat. And so this is a great balance. This show is really, really good. They do a 1 hour show in the morning, and they allow call-ins and stuff like this. I just like, when I need political stuff, I like this, because the Fox News obviously will give you one opinion. The MSNBC will give you the other opinion. And if you like that, like, by all means, tune in. It's like, I applaud you. But if you want that kind of middle discussion where you get a little bit of Democrat, you get a little bit of Republican, get like a moderate in the middle, this is not bad. This is not bad. Two-way. It's on YouTube. Highly recommended. That was not paid. They do not pay me to do that. They want to send the check. They can make it out to John if they want to. Tariffs on software products. I don't think software has a tariff necessarily, but when you have a service-based economy here in the United States versus a manufacturing economy in China, I mean, these are like big macro discussions. I don't know. This is going to be fascinating to watch how this plays out. I mean, it literally is going to be fascinating. What happens when Amazon replaces everybody? The problem, the thing is, what you need to understand about most labor jobs like Amazon is, if Amazon didn't do any new hiring, most of their workers would churn off. There's not like career warehouse workers. Now, there's a handful, right? There more than a handful. But out of the millions of people that work, a little over 1 million probably work in their warehouses, I would assume, most of them are there temporarily. And so Amazon actually has a churn problem. And so the same is true across a lot of different industries that you look at the low end of the payments spectrum, the minimum wage type job or slightly above minimum wage job. There's actually shortages there across the board. And so there's actually less threat to society to replace those jobs with robots. I've given this a lot of thought. There still will be jobs and opportunity for the college kid, for, even like, the 30-year-old that, and I got buddies. I'm from, Stockton, which is certainly not it's like the armpit of California. So I've got buddies that graduated high school and they didn't go to college, and they're not working at any, they're working at Costco, or they're working sign jobs, or they're working in manufacturing, or they're scraping by. There's still going to be those jobs. Those jobs are still going to exist. And on top of that, the cost of everything at Amazon should go down. So let's assume like I spend $1,000 a month at Amazon, which is probably about accurate. Well, instead of spending $1,000, maybe because of efficiencies and all those types of things, I might only have to spend $800. So now I have $200 extra in my pocket. That $200 extra is probably going to go into the economy one way or another. I'm going to go to In-N-Out Burger. I'm going to go to the pizza joint. I'm going to go to the movie theaters. I'm going to take my kids to the bowling alley. Those types of things. So those jobs will still be available, right? And now I'm speaking very broadly here, but that's in general how these things typically work. Thank you for the compliments. We appreciate those. Thoughts on Reddit? John, do you have any thoughts on Reddit?
Supposedly their data is going to be, that was their pitch during their IPO, was that their data was going to be, they're beginning to be able to sell their data. And that was going to be super, super valuable, especially to the AI app developers. And they have exceeded expectations for the last 3 or 4 quarters. So they've been operating very well. The stock was definitely a little ahead of itself. I don't know if you can pull out that chart, Colin.
Who's this?
I haven't looked at that
Reddit?
technically.
Oh, RDDT, I think. Yeah. I mean, here's what I would say about Reddit. I put it in the same basket as like Pinterest and Snapchat. It is like a second tier provider, and Reddit site is amazing, right? Okay. I'm not on there very much. It's amazing. Same thing with Pinterest. Pinterest is amazing, right? But it's it's like when we're talking about like Microsoft, this is Michael Jordan, right? Okay. When we're talking about Reddit, we're talking about, not even really Scottie Pippen. We're talking about like Horace Grant, and so, and that might go over the head of people because they're too young to remember, but, like one's Kobe Bryant, the other one is Rick Fox, like Reddit is Rick Fox, valuable, great, but, and I'm just speaking for myself, I like investing in Michael Jordan's. I have this saying where I like investing in gold medal winners. I imagine, John, this is how I imagine stocks, that all the tickers are, how you have the opening ceremony of the Olympics and like all the athletes are down there. So I imagine that's like the stock market down there. And I, as an investor, I have the chance to go down there and pick the athletes I want to invest in. Okay. So if it's the Summer Olympics, John, I'm walking down there. I'm like, where's the men's USA basketball team? Or even better, I think the women's USA basketball team has like never won anything other than gold. So if I want a guaranteed gold medal, I go down there and I find, American gymnastics or Russian gymnastics or Michael Phelps when he was swimming. Like pretty much if you could invest in an Olympic athlete, you would have invested in him. Same thing in the stock market. Buying Reddit is like you're taking a shot on, somebody that's never won before. They're going up against like better athletes, better funded athletes, better trained athletes. That's just how I look at it. And so Reddit is interesting. I also would look at this as more short term. There's certainly from a trading perspective, and John would be better at indicating these indicators than me. But my guess is, oh my God, there's a gap here. That gap, if it fills, then you've got a shot. But hanging above this gap is really, this makes me nervous.
Yep.
Yeah. So this gap looks like it wants to fill. Gap fill is basically just this gap will get filled with not a green candle, but a red candle. And so the first area where Reddit looks interesting is back at 82 is how I would say it. Just technically, this is really like, I don't like how this looks. This is scary. But that gap fills, then all of a sudden that trend holds right there. So that's what you're looking for.
The way we'd be looking at it, those from the small cap product too, would be think about it like the front side or the back side of a mountain. So we like almost everything we'll be looking for on the trading product will be the front side of the mountain.
And there's the mountain right there. So yeah, if you got this one at 107, you wouldn't have got out at 239, but like at the top. Don't think like you need to get out at the top, but that's a short-term thing because you've just round tripped on this one. Like almost nobody has made money on Reddit, right? Because some people bought the stock back here and you could slap on like a fixed rate volume profile and this like shows you, and maybe I'll be proven wrong here, but yeah, I mean like a good amount of people accumulated down here at 55, but my guess is some of them exited up here. So you don't have a lot of people. Look at the
big volume on the gap up. So anyone who bought off after that gap up on that, the biggest volume day or week of the last several years. I'm sorry, the single volume, not the volume profile.
Yeah,
down the volume down below.
Here, right here.
Yeah, that's
on the gap. Yeah. On the gap, it looks like there was huge volume.
Yeah.
So like right where the stock is right now. So it needs to hold this level, but you got a
Yeah.
gap underneath. It's scary. There's like no demand for the shares there. You had a lot of people buy this one at 160, 170. So you probably have a lot of bag holders, that are down 170 down to 1 on this one. That sucks. You know what I mean? Like I can ride Google down, but that's scary. That's scary. But yeah, from an AI perspective, there's some interesting stuff. We had a super chat. I don't know what currency this is. New Zealand dollars, or I don't exactly know. With the tariff, Sandeep. First of all, I appreciate it, Sandeep. With the tariff, that's probably, my God, Trump and his guys are going to take a ton of that. Lulu, I love Lulu. I love Lulu's product. The chart has gone sideways, which is not great. You should have support at Lulu right here. Oh God, you don't want to break too much lower than this. Somewhat scary from that perspective. The chart is kind of scary because it looks like this is like Tesla's chart almost. Maybe not with this dip, but Tesla's like gone up, sideways, gone up, sideways. So you're doing that with Lulu. I'd have a stop on this one. Wouldn't want to see it get below like 230-ish. Yeah. And then the tariffs can't be good. Let's see. Lulu in the after hours is oh my God, down 11%. So yeah, this one's at 250 now. Yeah, this one's on a cliff right now. If I were to buy it, I'd want to stop because your next area of support is at 60. As crazy as that sounds. Yeah, there's some action here in the middle, but my guess is when you slap this on, it's not going to be pretty. It's not going to be pretty. I don't think. Oh God. Yeah. So there's your support down at 60. So this is always humbling to do this. Now it doesn't, these volume profiles, what it's showing you is where the accumulation was. And you don't have to actually, like, if you don't have access to this, like obviously when a stock goes sideways, people accumulated it during that era. And then when it like kind of skips through some price action, it means not a lot of people were able to get in at that price. And so you have accumulation at a higher price, you have accumulation at a lower price. So if you break the support, you just, the lower price is a magnet. And that's what I'd be scared of. Yeah. A $35 billion valuation. Fundamentally, it should hold up, but with the tariffs and all that other stuff, scary. There's also a lot of competition in with Lulu, and they haven't attached their brand. One of the reasons why I like Nike is, you have Michael Jordan, they've attached their brand to athletes and celebrity, which is like a thing, right? Lulu hasn't done that, like they've sponsored some golfers and stuff like that, but they don't have that, like, it's like Michael Jordan is his own thing. And so when you attach your brand to him, that's a good thing. Lulu hasn't attached themselves. So I worry it's like an Under Armour. Like Under Armour is like another one where it's like, yeah, at one time it was high and then you break support and it's like, it sucks. So see what happens with that one. TSM, Vale. Remember I had Vale all the way back when. Vale, what's that doing? Oh my God. Yikes. Yeah, it's not too bad. I remember I bought it remember I bought it on this dip in 08. I remember I bought it on this dip and I ran it up. No, I didn't get out at the top, but I got out of it. The conference, I don't know if this old CEO is there. Vale, I don't know enough about materials mining, all that stuff. It's just too much. ACN. John, what do you think about God, what are they called? Consultants.
Yeah, we had interestingly we had a conversation. I think it was a week before that big red stick, those big red sticks, gross. Talking about the threat that consultants had to cuts in the government spending. ACN has I don't think their business model is quite as dependent on getting paid for time. How long do they take to get a project done? But I do know that Doge is taking a big cut out of that, and they do have exposure to the Doge cuts. Let's put it that way.
Here's the other one: is Booz Allen Hamilton. The Wall Street Journal reported they got like 90-something% of their revenues from consulting gigs in Washington. And so, yeah, so that's, I mean, it's ugly, huge volume. My God. So we'll see. But I would sidestep that. Hymns. My God, how much time do we have, John? Do you want me to start talking about hymns? Technically, it looks great in the short term. You're right here on support. I mean, there's multiple areas of this uptrend that has been attacked since 03. Fundamentally, not as bullish on hymns. Not as bullish on hymns. I think that they have some lawsuit threats that they could face. They are also I know they've gotten into like compound formulations and all this stuff, so they're more than just a reseller. Also, I think retail has completely underestimated how much competition is out there. Like I see people make posts like, "Oh, Hims has no competition." It's like, are you blind? They have a lot of competition. Yeah. So, and then like Roman that I don't think is but like literally like I think Zepbound has it like, or no, Eli Lilly Direct. So you have Eli Lilly Direct or something.
Yeah, some of
so
them are
you
going direct.
literally can go to, so you literally can, like, if you wanted Zepbound, which is like the weight loss thing, you can go to Eli Lilly directly and get a prescription to it. You know, I don't know how easy it is, but like you can literally go to Eli Lilly and get this stuff. So like literally the makers of the medicine are a competitor. So when I see like, oh, Hims has this great competitive advantage, I think in some ways it does, but it's a marketing company. Hims is a marketing company.
And
okay,
just like look at their income statement. It shows.
Yeah. But I mean, it's just like Nike. Nike's not a shoe company. Nike's a marketing company. Okay, and their marketing has sucked. So I can see why their shit has fallen off, right? So this is a marketing company. They have to market their stuff because they have competition coming from all angles, including the drug makers themselves. You can literally go to Eli Lilly and buy the medicine just straight from them. So let alone there's like Amazon Pharmacy, right? So this is coming. This is coming hot and heavy. And my brother's still on here. I think he must have fell asleep or something. But like my brother's complete testament to this, and he won't mind me saying this. I'm not blowing him up. But he's a single guy, you know, he does his thing, right? Okay. So there's medicine for single guys when they want to like, you know, go out and do their thing. He was using like a Hims and Hers or like a Roman or one of these. And then I told him about Amazon Pharmacy and he was like, dude, this was like half the price. So like, this is coming, right? Okay. So this Amazon Pharmacy, they bought PillPack, they bought One Medical or one of those. Like, this is a thing. This is coming. So Hims is cool. I don't want to like completely shit on it, but like I'm scared. I'm scared of it a little bit, you know, on the competition side. Yeah, Besant said the NASDAQ has a Mag 7 problem, not a MAGA problem. I mean, here, yeah, in SBS, you bring up a good point. If you want to listen to what is happening, I would not listen to Trump. I also would not listen to any commentary of, MSNBC or Fox News commentary on what Trump said. I would do exactly what you said. Go listen to what Scott Besson is saying and go listen to what Howard Lutnick is saying. They've both given long form interviews, both on CNBC, but also on like the All In podcast. They're going to tell you what the plan is. Elon Musk and Donald Trump are terrible communicators at what is happening. Like literally. And I say that with literally the utmost respect for both of them. But they are both absolutely terribly political communicators. They're terrible. And I say that as a Tesla shareholder and as somebody that is a fan of Donald Trump. They're terrible at communication, political wise. Past the bedtime, Jordan. Yeah, we'll probably wrap it up. I tell you what, we've got so many comments to go through. We've had so many of you tune in. In fact, I think we're still like at a peak in terms of viewership. We've got like over nearly 1,000 people tuning in. We're 3 hours deep. I've done these lives in other subjects and other forums where I've gone on for like 10 hours. We're not going to do that tonight. John, do you have any parting words for the faithful out there that have stuck with us all this long?
First of all, I want to say thank you. I mean, it's been a pleasure. Thank you for the great questions. The original plan here was to to just have a conversation that was going to be insightful and a little thought provoking. And I want to thank you for the thought provoking questions too. So it's been a great experience, and hope to provide a lot more of these encounters going forward.
Absolutely. And and yeah, thank you all for being an audience for us. It is amazing that, you guys have an interest into what we were saying. I remember, John, and you probably can reflect on this, sitting in my room looking at financial documents and listening to conference calls, and the fact that people actually care what I have to say and what we have to say on this stuff is really cool, and we really appreciate it. And so I would be having these discussions and be thinking about these things on my own. And so the fact that we can share this all with all of you is a privilege and an honor, and something that will continue to go forward. Anybody that's worried whether or not we'll do free content in the future, have nothing to worry about. In fact, we'll have more free content than probably ever before going forward. With a little upsell, we'll be like, hey, go buy my thing. And if you want to, that'd be great. If you don't, that is completely fine. And we really appreciate it. Thank you so much for everybody that has tuned in. We really,
thank you guys.
Really
appreciate
it. Yeah.
It's been a lot of fun.
We'll come back. Next time there's like something interesting that happens, we'll plan. I think the next plan is probably like Nvidia or Tesla earnings. And so we're probably like right around the corner from doing one of these things. Tesla earnings might be somewhat interesting. They're in 27 days. Nvidia's are much further. They're usually, another 30 days almost after that. They're in 56 days. I think those will be really important. But if Trump does something, or today was special. I knew when Trump was planning and hyping this up, he was going to go full TV mode and do this kind of stuff, which I think is kind of silly. And it kind of cheapens, I think, what they're actually trying to accomplish. It also makes people uneasy and unsettled. And as we're talking right now, S&P 500 futures are down 2.7%, NASDAQ 3.2% negative. And look, the Russell's bounced back, now down 3.8%. So we'll see what happens tomorrow. Really appreciate everybody tuning in. We will see you again very, very soon. Thank you for tuning in. We'll be back some other time, some other place. For now, we're out of here.